Good afternoon, everyone, and welcome to the first FDI Tech event focused on banking and fintechs and how the future is now. I'm Sultan Megji. I'm the Chief Innovation Officer here at the FDIC, and I could not be more excited for this event this afternoon. We're going to have three amazing panels with wonderful people that I've met since I joined the FDIC, people from the sector, people from nonprofits. And as we go into this afternoon, I'm excited for the dialogue. I'm excited for the energy. But most of all, I'm excited that we all realize that this future is now, that there is this new sense of urgency in terms of the changes to the banking sector. We're going to talk about three specific areas. We're going to talk about the market itself and how that's evolving. We're going to talk about how technology is changing it, and we're going to talk about diversity, equity, and inclusion. These three panels are, I hope, going to be valuable for all of you and going to be valuable for all of us to learn a little bit. We have just an absolutely wonderful group of people. And as we do that, I wanted to frame up just a little bit of how we've been talking about innovation here at FDIC. We really wanted to make sure as we launched this new program early this year that we included these components very early on in the discussion under four innovation themes. So first was around inclusion and how can we make sure that we're not just building the most diverse, equitable, and inclusive banking system out there, but that we're also looking at what we could do better with the existing system. We're looking at operational resilience. We're looking at how these systems operate and how everything from cybersecurity to climate can impact the banking sector. We're also spending a tremendous amount of time amplifying people. As we continue to evolve from an analog to a digital society, the financial sector and banking in particular is going to evolve as well. And how do we do that? And then we always have to be thinking about the future. I'm excited that I will tease that I know we're going to have a little bit of a discussion about something called quantum computing, which is something very close to my heart that I'm incredibly excited for us to talk about. But overall, this is going to be an event that hopefully you find interesting and exciting. And I hope to bring more of a dialogue like this moving forward to the discussion. So with that, I will turn it over to Jeff DeLuca, who can spend a few minutes with some housekeeping activities, and then we can jump right in. Jeff, it's over to you.
Thank you, Sultan. Good afternoon. My name is Jeff DeLuca. I'm a senior financial analyst with the FDIC and a member of FDI Tech. I am very excited to be moderating today's panel titled Innovation in the Financial Markets. This is the first of three amazing panels this afternoon. Before we begin, I do want to go over a few housekeeping items. First of which, this is a live streamed virtual event, so please do excuse any dogs that may or may not bark in the background. Particularly if they're my dogs, they don't actually count. You won't hear them. Additionally, we do have an event disclaimer, which is shown on the screen, which I will mention a couple things here. While many of the speakers with us today would disclaim that their remarks are theirs and not necessarily those of their company or agency, we too preface the event by saying we do not necessarily endorse or agree with all aspects of our speakers' views, but we certainly welcome and invite today's conversation. All right, so with that out of the way, I would like to kick the first panel off. We have four outstanding panelists for this discussion, and we'll also be honored to have our host Sultan sit in on the conversation. I will start off by asking the panelists to unmute and introduce themselves. We will start off with Diane.
All right. Thanks, Jeff. Thank you for setting up this panel, including me. I'm really looking forward to this conversation, sharing my thoughts, and also learning from my other panelists. My name is Diane Ellis. I am the director of the FDIC's Division of Insurance and Research. This division has most of the FDIC's economists, some financial analysts, policy analysts, and others. And we do research and analysis on a wide range of topics related to banks and financial services, including macro risk analysis. We also do deposit insurance pricing and fund management.
Thank you, Diane. Let's go ahead and introduce Rob next.
Great. Thanks, Jeff. And thank you for having me and hosting this wonderful event. Really looking forward to the discussion. I'm Rob Morgan with the American Bankers Association. I lead our Office of Innovation. So spend about half of my time working with our banks, helping them work with startups and other technology companies to bring the latest tech to their customers. The other half of my time engaging in public policy issues to help promote innovation.
Thank you, Rob. Next, we have Kate.
Thanks, Jeffrey, and thank you all for putting together this event. I'm really happy to be joining you all today. My name is Kate Goldman, and I lead the Milken Institute's Fintech program within our Center for Financial Markets. The Milken Institute is a nonpartisan think tank. We have global offices, and my work in fintech focuses on access to capital, financial inclusion, and lastly, transparency and compliance. So looking forward to the panel.
Thank you, Kate. And last but not least, Julian, if you go ahead and introduce yourself.
Thank you, Jeff. Mirroring, thank you to FDIC Tech and to you, Jeff, for putting together such an apropos discussion. It's a real honor and privilege to be with industry peers and to have included me in this discussion. I'm Julien Legoc, and I'm actually in my old stomping ground. I spent a decade at the FDIC. Super happy to be here. However, I'm currently the head of enterprise risk for a company called Circle. And so Circle is a fintech firm, which think of fintech as the convergence of technology and banking. And what we do is we help internet native companies accept and send interoperable type of payments everywhere in the world, both on traditional rails as well as digital financial rails. Very happy to be here. Jeff, back to you.
Thank you, Julian. So this is a discussion, so it's going to be going back and forth. If everyone has any comments, please go ahead and chime in amongst the panel. At this time, I'm going to open up the conversation with our first question for the group. The first question is, with a focus on innovation in the financial markets, looking at 2020 and 2021, in the midst of the pandemic, what technology evolved or expanded that you are most excited about for the market over the next few years? Let's go ahead and start off with Diane.
Okay, sure. Happy to kick this off. I don't know if I'll say excited, but I'll say, this is the thing I'm probably most amazed at, and that is the fact that how cryptocurrency has gone mainstream. I think it's pretty remarkable over the last couple of years how cryptocurrency is finding its way into a lot of our sort of mainstream financial activities. The Fed has done a survey indicating most Americans view cryptocurrency as more as an investment still than a payment mechanism, sort of like gold, stocks, or bonds. And indeed, a survey of financial advisors earlier this year showed that 1/2 of their clients were inquiring about investing in cryptocurrencies. 14% of these advisors were already using or recommending cryptocurrency, and 26% expected to increase their use of cryptocurrency in the next 12 months. So crypto is finding its way into retirement portfolios. We've got products like crypto IRA or Bitcoin IRA. The venture capitalist Chamath Palihapitiya said Bitcoin has essentially replaced gold. So it's finding its way into sort of traditional mainstream investment activities. We've also got government adopting it. We've got the example of El Salvador adopting Bitcoin as legal tender last September. We've got other countries considering the same. But actually, it's been shown that 27% of U.S. residents support making Bitcoin legal tender in the U.S. You've got cities like Miami launching its own currency or its own coin, Miami coin, to allow people to invest in the city. And New York City is expected to follow. And then, I noticed recently we've even nowadays got commercials by Matt Damon and Tom Brady on crypto. So I guess that's what I would mention as a highlight over the last couple of years is cryptocurrency is going mainstream.
Thank you, Diane. It's very interesting to look the way we look at crypto and the way it's hit the mainstream markets more recently. Julian, what do you think on this question?
Well, you can always count on Diane to have a whole bunch of facts and figures. So I'm trying to follow up with her. Well said, Diane. So, this pandemic that started 635 days ago, according to my godson that reminded me last night, he calls it the before time and the after time, and he just can't wait to get to the after time. But really what it's done is it's brought a decade of change in a couple of years and a change in how business and consumers interact with one another. And so what I think is important here, I know the question is on technology, and Jeff, hopefully you won't kick me off this panel right now, but I think what consumers, businesses, and merchants are looking for is perhaps not the underlying technology, but they're looking for outcomes, less so the technology really that makes it happen. So I think the discussion could probably be shifted from that the technology is not as important as the adoption curve. And Diane, you just mentioned it, how many Americans are looking into digital currencies, digital assets, cryptocurrencies. So I know a lot of people are paying attention to what is next. I personally am paying attention to what is now. And putting a little bit of data here, Diane, you might like this, but today the estimates are that more than 20 million Americans are operating in this digital economy, as well as 200 million worldwide. What does that mean in the context of kind of global GDP? About 15.5% of global GDP is currently involved in the digital economy. What does that mean? That means it's about half of the US's economy. And oh, by the way, it's been growing at about 2.5x global GDP for the past 15 years. So I think the example here I would have in the analogy is when you hit send on email, you don't really think about the technology of it going through an SMTP server and a DNS server and a POP and an IMAP and an MTA and all the DNS and all these type of things. You just want the email to get there. And I'm hoping that now the discussion is really going to be around adoption, which I think has happened and is continuing to happen, and really starting thinking about the outcome.
Dylan, thank you so much for that comment. The pandemic definitely did push a tipping point in terms of technology. So I think that those are really, really great reflections and comments there. Kate, what are your thoughts here?
Yeah, similar to what Julian said, I wanted to call out retail investments, and the technology behind these. It's not like they were created in March of 2020, but the way that consumers are engaging with retail investment tools has radically shifted. And I think that's partly because we've all been home for the last 2 years and because of stimulus checks and just this newfound excitement to get involved in investments. And the technology behind retail investments have dramatically shaped the course of how people engage with these financial tools. Now people can invest in fractional shares right from their phones with fewer fees than we ever could have dreamed about 5, 10, 20 years ago. And then not only that, but we're seeing artificial intelligence and just swaths of data become so readily available to people just through the internet. This user-centric, this high-touch investment portfolio is all of a sudden become democratized. And I think the last thing that really stood out to me throughout the pandemic in retail trading is just how social it has become. We saw pools of the internet become communities for investors to communicate with one another, be it Reddit or TikTok. All of a sudden, irrespective of where you're living, you're able to communicate with people and, share investment tools and discuss and talk amongst one another. I think that is a really fascinating convergence of all these different trends in technology and financial markets and resources sort of coming together in the perfect storm of really interesting use of technology.
Okay, that's a really interesting perspective, especially when you think about throughout the pandemic, the limited in-person interactions we've had and the shift to a social network to non-in-person interactions, and the push through technology and through investing through those methods. Really good, interesting perspective. Rob, what are your thoughts here?
Yeah, thanks, Jeff. And at the risk of creating a really boring panel, I want to agree with everything that's been said to date and probably put a different lens on it, or at least from the banking industry's perspective. It seems like we're all saying the same thing. The story of the pandemic, from a bank's perspective, and I think from others, has been one of customer adoption. Banks have been investing in new technology for ages as well, and as we know, customer habits in banking don't change very often, right? Why fix what isn't broken? And I think the pandemic really forced folks to look at how they engage with all the products and services they use and to change some of those habits. So we've seen in past years mobile adoption increase. It was the 2019 FDIC How America Banks study that showed mobile was now the most prominent way customers were engaging. We at ABA have done some follow-up research that shows, unsurprisingly, that has only accelerated since the pandemic. So in many cases, customers became increasingly aware of the tech their banks already offered. And this was critical for helping customers and communities stay connected with their banks when they needed it most, through things like delivery of the Paycheck Protection Program and economic impact payments, being able to help bring those to communities, whether you were sitting in your living room or if you were out in the community. So that was really important. It's helped banks reach new customers, bring folks into the banking system who weren't otherwise involved. We think that's something that's really important, something that we've been focused on. But what's really been interesting from sort of the novelty perspective is the way banks have, as they've made that transition, have maintained the customer relationships and have used technology to do that, right? Community banking has always been a relationship business. And it used to be that those relationships were built when you walked into a branch and had a conversation about saving for your child's college fund. Today, those interactions are more happening with taps on a screen, creating bits and bytes. And the way banks are using that to better understand their customers and their needs is really exciting, right? The same way I feel like Netflix knows me, even though I don't know a single person that works at Netflix. Banks are using some of that data to understand their customers' needs and bring them the most relevant financial services when and where they need it.
Rob, that's great. I want to poke a little bit further there. You talked a lot about the opportunities that the new technology or the leveraging technology has presented to institutions, whether that's expanding existing relationships or fostering new relationships with the outreach methods. I'm curious what your thoughts are if you look at it from like a SWOT analysis, right? You hit the strengths, you hit the opportunities. I'm curious what your thoughts are in terms of potential threats to the banking sector that you see this new technology developments over the past couple of years posing to the financial environment.
Yeah, so I think one area where there's both opportunity and risk is sort of in the core infrastructure that underpins a lot of what banks do and their ability to adopt new technology. So the degree to which it works really is critical for banks to offer the latest technology, latest services to their customers. And one thing we have really put a focus on at ABA is core providers. So all of the banks in the country rely on their core providers to effectively interact with customers today, right? As those relationships move digital, today 80 or 90% of banks rely on one of three companies to power pretty much their entire tech stack. And in some ways, I think this is a story of success. We have been really heavily engaged with these companies over the past 3-4 years to highlight the needs that community banks in particular have. And we've seen a lot of progress in terms of banks' ability to first access their own data. That is one thing that we think is really critical. So community banks' ability to actually go into the systems of record, understand how their customers are using products. That's something that really is critical to helping establish and maintain that customer relationship. We talked about that a little bit. The second, I think, area we've seen a lot of progress is in the ability to interface and adopt new technology, whether it's through APIs or other means. We have seen those core providers, both sort of a new batch of competitors, as well as some of the existing players, move towards a more open model that allows banks to more easily and more quickly integrate the latest and greatest technology, whether it's from their core provider or whether it's from sort of a newer fintech company, something that is so critical to competitiveness going forward. At the end of the day, community banks aren't going to be able to build every single technology themselves. So the ability to work with a wide array of startups and established tech companies to offer those solutions to the end customer is key. And the ability to quickly and easily plug and play is I think, critical there.
That's interesting. When you discuss about different intersections between the banking industry and the fintech companies that are out there in the plug and play process, or how things will adapt or incorporate within to the core systems to offer customers different avenues or vehicles. Does anyone else have any comments on that aspect of the current fintech and banking market? Any other panelists want to touch that, or should I move on? All right. Well, I'll just want to mention, we do want to keep the conversation open, but I do want to ask it from a slightly different angle. Diane, I'm curious, how do you think fintech might change the structure of banking markets in the U.S. and looking also globally?
Yeah, I think this is a really, to me, one of the more fascinating issues is how fintech is changing the markets. It's one of the more fascinating issues for me to follow, because I think it has a potential to make significant changes to the structure of banking financial services. And there are really at least two reasons as I see it. One is the fintech's ability to unbundle traditional roles of money and then rebundle it with platform ecosystems that offer an array of other services. And then also I'll get to the data, which Rob was just sort of talking about, their ability to generate, capture, and analyze an incredibly large amount of data. I'm sure everyone's heard of the concept, data is the new oil in the digital economy. Well, fintechs are starting to control a lot of data and a lot of the most valuable data. So if you think about the traditional financial services hierarchy, banks have always sat at the top of that pyramid, in part because they had the best data. They had data that no one else had about businesses and consumers' financial lives. And other things like payments, other financial services firms, insurance, wealth management were an extension of the bank's normal activities of intermediation. But fintechs are threatening to disrupt that organization, in particular those involved in payments. What I find particularly interesting is that fintechs have made payments sexy. Like payments was never that interesting. It was a long time between the development of the check, to the credit card, to the ATM, to the debit card. But now we've got this proliferation of all these, payment vehicles and firms, and we're all talking about payments. And they really have unparalleled access to data on customers in both sort of the size of the data and the diversity of the data. There's a really interesting BIS working paper, and Julie, I can't help myself, quoting some of this stuff. I do lead a research organization. Anyway, this paper is called The Digitalization of Money, and it discusses this phenomenon and says that we could be moving from a bank-centric model to a payment-centric model. And in a payment-centric model, the payment provider owns the customer relationship and everything else, including a bank, which is in a supporting role. And you can really see this happening in China. With Alipay and WeChat Pay. Each of these firms has over 1.2 billion users. Alipay, of course, owned by Ant Group, and WeChat Pay owned by Tencent. They own banks that support their platform, not the other way around. It's the commercial firm, the payment processor, that owns that customer relationship. Now, I'm not sure I can see that happening in the U.S. in the same way, at least, because we have a more robust banking system. In China, when Alipay and WeChat Pay were sort of spinning up, they really had a banking system that was not nearly as robust, and it was very easily leapfrogged by those big tech companies. And that's just not as easy to do in the U.S., where banks already, are providing a lot of consumer and small business credit. Also, there are certain legal and regulatory barriers in the U.S. that actually prevent a payments provider from achieving the kind of scale that Ant Group or Tencent achieved. However, I really think it's an interesting phenomenon to think about, and it certainly seems possible that it's going to reshape this industry in some way.
Yeah, it's an interesting way to think about the way data is generated in the U.S. and globally. The shift of who has the most data and where the data points are coming from. So every transaction produces X number of data points, and how we use that data and leverage that data going forward, I think is a fascinating concept, especially looking at expanding relationships and experiences for customers and our institutions. So it's a great lineage which we can go down. Julian, I want to pull you into this conversation a little bit more. How do you see fintech flattening the global markets?
So first, I think we have the quote of the day, Jeff, which is that fintech made payments sexy. You can attribute it to Diane. I thought that was pretty fantastic. So let me double click on kind of your question here about flattening global markets. And, truth is digital adoption, as we talked about, and Rob very clearly stated in his opening remarks, they've taken a quantum leap, and I'm using quantum as a shout out to Sultan because I promised myself I would say quantum at least once, but I've said it, so now I'll move on. But we live in an always on economy. And what does that mean? But for fintech, the experience that consumers currently have, that merchants currently have, and really how the market operates is within the constraints of a bank holiday or within constraints of a 9 to 5. And some of the settlement finality times, as we know, take days instead of seconds. And I recall for 10 years going to the wonderful cafeteria at the 550 building as well as in Virginia Square. And I swiped my credit card and I walked out with an amazing salmon salad. But truth is, the cafeteria operator, Aramark, would only see that money 3-4 business days, depending on the day of the week that I swiped my credit cards. I think we could do better. And so I think we're far from flattening kind of the financial services environment. The fintech industry aspires to be 24/7 and making access to the modern financial system a reality for, let us not forget, 1.7 billion people are unbanked in the world, about as many are underbanked. Even in the United States, a fortress nations like the one that we are, FDIC numbers in 2017 showed 22% of unbanked and underbanked, and the Fed just did the most recent study that it's right around 18%. That means that the underbanked goes to alternative financial services places, which of course are check cashing and payday loans and rent centers. So what we're trying to do here with FinTech is we're trying to address this current market needs to complete the system. I think also the sentiment that we're feeling right now is a sentiment that we felt before. Think of telecoms, right? Where you used to pay a telephone call was based on the distance and how long you were on the phone. And today, essentially with a data connection, we're having this free. So think of where we were with email back in the day, where we are today with telecoms, and where payments are going. So I guess the TLDR is, I think consumers and financial needs, they don't take any breaks. And when you need to have a particular financial transaction, whether it's a micropayment, whether it's a remittance, whether you want to ensure that an individual has the funds that they require, it should be on demand and it should be always on. I think that's where public blockchains are trying to bridge that gap. FinTech and bank tech, and I guess FDI tech are bringing to the forefront the experience that many FinTech users are having, that they can continually access their finance, and that your value should be portable. You should be able to move across the world with your mobile phone, having access to your money, just like if you had cash in your pocket, except it's safer.
That's an interesting concept, that your value travels with you as long as your phone travels with you wherever you have access to your value. So does that actually make it so you don't need a bank branch if you travel across the world? That you don't need that representation to access your accounts or funds right there with you? Julie, I think that this is a really good topic, and Kate, I want to bring you into this also. I'm curious how you see financial technology expanding markets, and really how.
Yeah, I think it would be faster to say how FinTech isn't expanding financial markets. It has truly touched every single facet of the industry. But I think at its core, and the most simple but important thing that FinTech has done for financial markets, is really its ability to drive down the cost of every layer of the financial interaction, be it with a bank or a neobank or any sort of financial institution. It has never been more frictionless and less expensive to engage with financial institutions. And cost is cited as the number one reason why people are unbanked in the United States. Time and time again, FDIC surveys find that cost is the number one prohibitive barrier for people to be engaged in the financial markets. And so all of a sudden, when you have neobanks and fintechs that are lean, small companies, they're able to save such an amount of money on overhead and infrastructure costs that they can pass along those savings to their customers. And then for the larger financial institutions, the technology has allowed them to really open up their revenues and sort of bring in money in different ways. Capital One this week announced that they were going to stop bringing in overdraft fees from consumers, which was such a monumental move forward. And technology opens up so much of that, just allows from the largest to the smallest financial institutions to incur capital in different ways, in ways that serve banks, or rather serve their customers. And it becomes a much more healthy and sort of mutually beneficial ecosystem between the banks and between the consumers. And then to Julian's other point before, I think the adoption of digital identity systems, it has never been faster or less expensive to onboard new customers, no matter if you're a fintech, if you're a community bank with digital infrastructures. It is so easy to bring on new customers. So I think all of these pieces from fintech, or just from technology broadly, is doing such a huge push to make things more affordable, to make things so accessible. And in the pandemic, that has become incredibly important, especially as millions of people are without work this year.
That's great, Kate. So you touched on a lot of different things there, but really it sounds like it's boiling down to a couple areas where fintechs have really pushed boundaries or added to the current structure, which is access, expanded access, speed, in which we are able to access, and also cost. And it's interesting to see those advancements flow through the market and where those changes are occurring. Before we move on to the next question, does anyone else have any other comments on this area before we go ahead and touch the next question for the group?
I'll interject on the financial inclusion question. I mean, I agree with everything that was just said, and I think I would just add that this is really demonstrable in places like Africa, where you've got the telecom operators who have made great strides in improving financial inclusion in those countries, because while everyone didn't have a bank account, as a matter of fact, even larger chunks of people didn't have bank accounts, everyone had a phone. So we're used to interacting with their phone company, and the phone companies who had the technological investment to do it, capability to do it, we're sort of the first movers in that area. So it does kind of seem like a mobile phone and some good internet access, is a really viable way of sort of closing the gap on financial inclusion in our country as well.
Yeah, if I can add to that, I think, Diane, you're probably referring to Vodafone's partnership with M-Pesa in Kenya. And today, I think they have over 40 million individuals. They went from 85% of not access to the traditional financial system down to like 15, 20% almost overnight. And so I think what we're doing here is, fintechs are coming on and they're trying to complete kind of the system and really not compete with it, which is why it's such an interesting discussion we're having today.
But one of the things we do have to grapple with, I think, here is what they call the digital divide. I mean, we do need to be thinking about getting broadband access, to more places, particularly our rural, less populated areas.
Good news is that's the opportunity, Diane. So we've got, of the 1.7 billion that are unbanked, 1 billion of them have a mobile phone. And I think the latest numbers is we're at 63% of the globe that is covered access to the internet. And I'll tell you, in my travels in North Africa, it was amazing that individuals found access to the internet, whether it's going to a Starbucks to access their data point. It's amazing how resourceful individuals are to have access. So fully on board with you.
There you go. Starbucks may be the key here, right? Those are some good facts, Julian. Those are some good facts and figures, Julian. Maybe you should think about running a research department.
Don't get me started. I've got my mug with full of Starbucks coffee, Diane.
Last thing I would add to that point is, broadband is a huge precursor to financial inclusion, but also access to identification. In Africa, there's 540 million people across the continent with zero access to formal identification. There's millions, tens of millions in the United States as well, who are barred access to financial markets because they don't have access to identification. And, you look at broadband, you look at IDs, those are two things that I think we could all do a lot of work on to broaden access to all of the wonderful things that banking and fintech are offering in the space.
It's interesting. So it sounds like a lot of the speed, the access, the adaptive technology, a lot of the push, I keep hearing the phone and the internet, right? So the ability of access to, or more access through a mobile device, has opened the doors to a lot of different abilities to transact and interact with our institutions or financial markets. And it sounds like the expansion of the internet, whether it's broadband or different aspects there, will expand access even beyond where it is today. So, Julian, I heard you use a term, and I do want to address it because I like the term, and I'm curious what everyone here thinks. Is fintech the answer to complete and not compete? Do we see this as a piece of the puzzle to make the experience whole between customers and financial institutions or financial markets? Or is this another avenue to compete with the current structure? Or is it a mix?
So I guess I'll take it first, but I really welcome the panel's input into this. My assessment of the current situation is consumers want optionality. And so you have some consumers that want to remain in a cash society. You have some countries that have moved to a cashless society. You take Sweden, they're about 99% cashless, correct? So I think what fintech is bringing to the table is one more option for consumers to leverage what they want. And truth is, and I love that Diane said payment system is getting sexy. Most of us, the payment fees have been opaque. When we slide our credit card and we walk out, we don't know that the merchant is paying 1, 2, 3, 4%. Remittances around the world are 6.8%. They've been stubbornly high for the past decade. And so this adds another level of option for consumers. And I'll be honest with you, I was in Mexico just about a month ago and I received a bill and I was amazed, but the bill was priced differently depending on if I paid in US dollars, if I paid in pesos, if I paid with my American Express, and if I paid with my Visa. That was the first time in my life that they actually gave me the option. And in the end, the US dollar was the cheapest thing for me to pay my bill.
That's an interesting way to look at it, is built-in transactional costs within the payment of services, right? So I've never heard of that before, where you've gotten a bill in different forms. But I guess in terms of listening to different areas of the country and seeing how how those transaction costs get built into the final product, it's fascinating. Does anyone else have any comments on whether we see fintech as an area to complete or compete with the current infrastructures?
Yeah, I'll jump in there. Oh, go ahead, Kate, please.
I would just say I think it's totally complementary at this point. If you'd asked us all this question 5, 7 years ago, I think we'd definitely say it was fintechs versus banks. And people realize that, like, I don't want to choose between using Venmo and PayPal and having a bank. In my ideal situation, what we all are afforded right now, it's having the best of both worlds. And I go to, my bank is actually largely branchless. I use USAA. I think they have one branch in Texas, and I've never been to Texas in my entire life, but it's a fantastic banking relationship I have with them. But even still, I'm so glad to be able to use, Venmo if I want to send my friends money. Half my friends are in Canada and Venmo doesn't work up there, so I can use PayPal. Like, having all of these options makes for the most healthy relationship with all of these financial institutions. So I think it's totally complementary.
Yeah, Kate, I was just going to echo the same sentiment, right? I think there was maybe a time where there was a fintech versus banks dynamic. And it's not really a surprise, right? If you look at the first generation of fintech, you had a bunch of really smart entrepreneurs who had never really been in banking or connected to banking and wanted to make banking better. So the natural action was to compete, right? Here's what I think I can fix in this component. And one of the things we've been working on from an ABA perspective is better connecting those entrepreneurs with some of the problems that banks face, trying to help give them the tools, the insight to help solve bank problems. And I think we've seen a lot of those companies, some that began competing, are much more complementary now and really want to work with banks to help bring the best experience possible to the end customer.
Great. So along these lines, when we're looking at complementary, financial technology in the banking system, with these new adoptions of innovative technology, and this is going to be open up to the group again. I'm curious to see within the financial markets, how important is trust for the ultimate adoption and push forward for these new technologies? Is trust needed for all financial technologies, and how's it being built into customer-facing technologies? And we'll start off with Kate.
Yeah, so I think trust is everything. In any relationship with a business and a consumer, trust is paramount. When you look at certain sectors of the market, like social media, where there is such a concentrated group of players, that really, trust doesn't have to be paramount to their business models, because as the consumer, you don't have that many options to go elsewhere. And so in financial markets, as they've become so competitive over the last few years with the emergence of fintechs, with the emergence of neobanks, that competition has made trust of your financial institution become so much more important, and it's really forced all of the financial players, from like the largest incumbent bank to the smallest neobank, to step up their game and become more transparent with consumers. And I think all of that is massively important. Again, the same survey I cited before from the FDIC, trust is the number 2 reason why people are unbanked in the United States. And so trust is still integral in the relationship between banks and consumers, both with, existing relationships and those that you're looking to build as a financial institution, bringing in the unbanked, bringing in consumers from different financial institutions. All of that is massively important. And the emergence of technology, blockchain, data interoperability, all of that is becoming really key for that trust and for that transparency. And banks have, or financial institutions rather, have an easier way to show sort of like, here's what we're doing when it is so transparent, or becoming more highly transparent day by day.
So, Kate, along those lines, are you seeing banks as filling in that gap between the customers and these new fintech technologies or advancements, filling that trust gap? So through the partnerships or through the different avenues, is that a role that are to help facilitate the move forward?
Yeah, I think so. I think banks have the leg up of being sort of legacy institutions in the United States. Like, when you look at the architecture of a bank, they're marble, they're grand, they have this sort of energy about them that makes people feel literally safe, like the columns, like all of that is done quite strategically to build this sense of like, oh, like this is where I want to put my money. And fintechs, yeah, they've had a lot of catching up to do because people are still getting comfortable with the idea of operating in a mobile only relationship. So banks can, they can help each other out. Banks have work to be done on the trust side, but they also have, the benefit of being there from the very beginning.
It's interesting. Diane, what's your take here?
Well, first of all, I'd like to say I love this question about trust because I think it is so important. I can't agree with Kate anymore that trust is paramount. And by the way, thank you for citing our survey data. We love it when people find it useful like that. But trust is at the foundation of our system and financial system, and I think it does often get overlooked or it's not talked about enough. I mean, you can't have banking, you can't have financial markets, you can't have commerce, and so on without trust. In our traditional financial services system, we have intermediaries. It's the government and financial institutions that have served as a trusted third party. And, we think a lot about trust at the FDIC because that's our role, is to back up financial institutions and to and make them inspire more trust or confidence, so they can do what they need to do. So, you have to come to consensus about the validity of a transaction. And in our trust-based model, it's these third parties, which serve as the record keeper and incentivize honest reporting and so forth. But I think what's going on here is that, that trust-based model is costly. These third parties extract rents to cover their costs to serve as record keeper and also to mediate disputes. And that increases transaction costs. And sometimes it eliminates the feasibility of small transactions. And also, because they're mediating disputes, transactions can't be irreversible, because the third parties can't help but reversing. So parties to the transaction, whether it's a merchant or lender, whatever, they have to conduct due diligence or be wary about their counterparty. And of course, there's fraud and so forth. So, when you're dealing in cash, that avoids all those problems, but you can't use cash on the internet. So, here comes blockchain, and I see blockchain and the experiments and developments with blockchain is just trying to figure out how to shift this trust around and make it less costly. So it replaces a trust-based model, with a system based upon essentially cryptographic proof. It tries to place trust with confidence in a computational system, which is, to me, two sides of the same coin. So different developments in blockchain are trying to develop trust in different ways. If you're not going to have your trusted third parties, banks, with the costs, with the fees and so forth that they charge, you're going to have to do it another way. And so you've got a proof of work concept where you have to use lots of resources. to develop that consensus and trust. Or you've got proof of stake, which essentially looks to other external sources of trust among individuals. But as I see it, they're just different ways to achieve trust. I mean, that's sort of what we're in search of, is how to develop that consensus or that trust in the least costly, most efficient way. But it's still incredibly important.
Dan, thank you for bringing up a blockchain. That's a great segue into a bunch of different conversations we can have into distributed ledger and blockchain technology, and how it's leveraged into building trust into an environment that is diverse and a new way to look at transactions. So, Julian, I'm going to refer the same questions to you and see how you think new technology within the markets and how important trust is for the ultimate adoption and push forward.
Jeff, this is one of those questions that I wish you had called on me first, because going after Kate and Diane is almost impossible. So I'm going to try to kind of give an answer that's a little bit nuanced, but from a different perspective. So if we start looking at kind of the macroeconomic angle of trust and adoption, even in some cases where you have sovereign money that is being issued by a central bank, 50% of individuals in the world today, they face hyperinflation. Now, not all countries have an FDIC with a track record of no depositor. I'm testing my FDIC memory here. No depositor having ever lost a penny.
No insured depositor.
No insured depositor. Thank you, Diane. Have ever lost a penny since 1933. Not only to me is that a trust and innovation enduring type of establishment, but this is for the traditional money. So now let me shift to blockchain. And Diane, you just touched on that. So what some blockchain projects are trying to do is to build code and connect trust construct within it in the public blockchain. What does that look like? Well, most individuals are unaware that the most money that's currently in circulation is private money, private issued money, and that it's fractionalized banking to ensure that there's free capital out there for lending, which is needed for the economy. What a lot of these stablecoin projects are doing is they're offering something a little bit different, that you have a one-to-one backing. And therefore, I think some of the trust that is being built within the fintech environment is ensuring that you have $1 to one stablecoin in a fully reserved financial asset class. Therefore, somewhat different than traditional banking. Again, I think both of them are complementary of one another. And USDC, if you've heard of it, this is Circle's digital currency, is essentially taking a dollar and applying this dollar with the power of the internet. And I think that's extremely powerful. And individuals will again have a choice on trusting the traditional bank, which we have done for years, or trusting some of the new projects, such as stablecoin projects on the internet.
All right, Julian, I do want to circle back to stablecoin, but I do want to ask Rob what his thoughts are on trust. And Rob, to Julian's point, I do apologize for you going to have to follow up on everyone else that's commented on it. I am changing up the order a bit here, hoping that this, it doesn't become a recurrence among the questions. But Rob, what's your take on new technology in the financial markets and how important trust is for the ultimate adoption and push forward?
Yeah, thanks, Jeff. And look, I think a lot of this has been covered, but it's paramount, right? Trust is everything in this space, particularly as we think about innovation. And innovation is only useful to the degree that we maintain that trust and build on it. And look, I might be willing to get in a stranger's car for a 5-minute ride, but I'm not going to give them my life savings. The reality is I probably don't want my bank to move fast and break things. And so trust, as we roll out new technology, new innovations, maintaining that trust is really critical. That's one of the reasons we are so optimistic about the role of bank fintech partnerships. We think it is an opportunity for banks to work with some of the leading edge technology companies to bring their customers the latest and greatest technology in a way that they can trust and they know through experience will be backed up. Now, Kate, I would maybe disagree that it is sort of the marble. I think a lot of that trust stems from the regulatory structure, the oversight, and ultimately the FDIC backing, right? The fact that we talked about no insured depositor has ever lost funds. And I think the key there is sort of maintaining it as we go forward. There are some areas we think there's a lot of opportunity, But there's also some risk, right? As we see this sort of unbundling that Diane hit on earlier, we're seeing new models. We are rethinking the idea of what it means to be a bank. Not everyone who wants to be sort of a bank thinks of it the same way we used to. And a lot of our rules and regulations were built around sort of deposit insurance being the center of what it means to be a bank. We obviously think that's very important. Our members do think that deposit insurance is key. But there are other business models that don't necessarily rely on insured deposits. What we need to do is make sure that sort of the regulatory definitions match up with some of those new business models. So just because someone is adopting a new technology, a new business model, they don't inadvertently fall between the cracks. And I think that's where we risk losing some of that trust, is if you have new business models, companies that can look a lot like a bank, offer sort of that rebundled set of products and services that looks and feels like a bank account, but isn't subject to the same proactive supervision oversight as an FDIC insured bank. And I think making sure there's clarity between them and consistency for consumers is really key to maintaining that trust.
Thank you, Robert. You mentioned, Kate touched on the marble aspect, and you mentioned that that's, obviously not as important as some of the regulatory aspects and the insurance aspects. And it brings me to a thought. I'm curious if you need, or what the role is of a physical infrastructure, a branch, a main office, a place to actually go to. How does that build into the trust environment? And is there a generational divide, in terms of actually walking into a financial center?
Yeah, so this is a question we get asked a lot. Are branches going away? Right? I think my answer is no. And one of the analogies I like to use is one of the sort of most digital forward brands that we all know is Apple. Right? When you think of Apple, you think of the glass front stores. And Apple's stores don't exist to sort of sell laptops, right? Apple sells less than 10% of its products through its stores. But the stores serve a really important role, right? Number one, the stores exist because Apple sells a really complicated product. I don't know how many megs or gigs I need in my computer to get on this WebEx today, right? So I want to go in, talk to someone who understands my needs about what type of product I need, right? A lot of analogies to banking there. And then the trust is equally important, right? If I just hit a button online and a computer shows up at my door, that's fine. But if something goes wrong, I typically want to be able to go in, talk with a real person and get it sorted out. So that's really important. And I think the last thing, as we sort of move back to the banking analogy here, is the presence in the community, right? Banking is that relationship-driven model. I don't want to, and I think that sort of the sum of these answers is the nature of the branch is changing, right? You go to your branch less for transactional day-to-day activities because you don't need to. I can take a picture of a check. I can video chat with a teller, but that presence in the community is important, particularly for building relationships. So I think the nature of the branch is going to shift more towards that relationship model. But even with generational shifts, I don't see branches going away.
Perfect.
Just
Kate,
add, I was going to say, I do not think that Marble is doing more for trust than actual, FDIC depository insurance. I think the physical infrastructure of a bank is almost the symbol of that trust instilled by depository insurance, because the average American, they're not thinking about $250,000 per customer insured depository. Like, that's not the first thought that goes through our heads when we think about banks. Well, maybe for the five of us it might. But for the average person when they're engaging with their bank, I think they're complementary, and I think they're sort of two sides of the same coin. But yeah, I completely agree with what Rob said. And yeah, I think it depends on what demographic of people you're talking about. Older Americans still heavily rely on in-person interactions with their banks. Younger people, less so. I mean, unsurprisingly, younger people rely more so on fintech and are more comfortable with engaging with their banks on their phones or online. And I imagine that will shift into more of the majority as, my generation becomes the oldest generation at one point.
I think, Jeff, we can start a coalition of replacing "In God We Trust" on every single greenback with "In FDIC We Trust." I don't know. You might start that. I think it might make a difference.
I'm not sure. We'll see on that one. We'll circle back on that one. Julian, you touched on stable coins. I did want to circle back to that briefly. I wanted to open it up to the entire panel here on where you think stablecoins are today, where they could go in the future, and are they a disruptive force, or are they something that could put new inroads into financial capabilities and availabilities in a global market? And also, what your take is on stablecoins. Julian mentioned the dollar backing. However, there may not necessarily be a quote unquote definition of that dollar backing or testing of it. So that's why I'm kind of curious to see what everyone's take is here. Jump in as you see fit, since this is just a sidebar conversation.
I'm happy to go first, Jeff. Kate touched on interoperability. And I think today you may be a Venmo user, and Kate had the example of her friends have PayPal and Venmo, and PayPal owns Venmo, but you can't actually send a Venmo payment to a PayPal user. But if Kate and I go downstairs, again, using the Starbucks analogy, I can actually hand her $1 or $5. So the physical dollar is only good as the length of arm that you can extend it out to an individual. I think this is where stablecoin really changes the game, where you can actually have interoperability, especially on public blockchain, where you have settlement times that are down in the micro seconds and not the days. And again, I think it just expand the reach of the US dollar. And so you're right, we have a presidential working group, a paper that came out 3-4 weeks ago that talked a little bit about what stablecoin project needs to look at. I was really excited about it. All I want is a regulator and regulations to tell us exactly how we need to operate. But I think this sentiment also we've felt in the past when telecom companies rolled out to the FTC and said, internet telephony should be banned and it should be illegal, and here we are today. So I think, again, this is a progress, and stablecoin is a progress. You may have seen this year, I think the stablecoin market, there are approximately 200 stablecoin projects. Not all of them are created equal, and we can get down to which ones we think are more equal than others. But, it's about $130 billion of value right now. Starting out the year, much less than that, about 600% increase from last year, something like that. So stablecoins, I think, are here to play and stay, and they just offer one more option for the consumer to extend their digital US dollar on.
Fascinating. Does anyone else want to add anything, or we can move on to the next area I want to touch on?
Yeah, I'm happy to jump in quickly.
Please.
Julian, I thought that was, I agree with a lot of what you said. I think there's a lot of opportunity here. Clearly is a market that's developing quickly and obviously challenges a lot of regulatory assumptions, right? This is one of those markets where we see market adoption really outpacing regulatory ability to sort of keep up. We have a product that in many ways looks and feels, and I think it's appropriate that that I'm seeing so many FDIC logos here, right? Looks and feels like a deposit alternative. Right. And so how do we maintain trust while still sort of harnessing the opportunity that is presented here? You mentioned the President's Working Group report. I think in many ways, we thought that was a really good path forward. We thought that had a lot of recommendations that made sense, frankly. As you look at what a stable coin is and sort of those assets backing it, it does start to feel a lot like a deposit, right? You have sort of a basket of assets that are being held. You're validating that it is worth sort of the dollar that you have as that store of value. And whether that is really there is really important to maintaining that trust, right? I won't sort of name names and different, but there's one stable coin where the founder sort of famously said, it's worth $1 if you think it's worth $1, whether or not we have the assets backing it. I don't think anyone on this call would think that is the right approach. So how do we make sure that it really is worth that dollar and that you can maintain that trust? So the recommendations in the report, we think it makes all the sense in the world for issuers of stablecoins to be considered insured depository institutions, because that's what banks do, right? And so a lot of work to be done, a lot of discussions to have, and I'm sure the market will evolve before we get to that endpoint, and we'll have to evolve with it. But we think that's a good directional path forward.
Hey, Jeff, can I ask a question? Or is that okay? On this line, I'm just curious anyone's views on the relationship between stablecoin and central bank digital currency. I mean, if a central bank, a CBDC is introduced, does that take care of that interoperability function that stable coins, are providing? And is there still room for stable coin if a CBDC is around?
So I'll take that one, Diane. So my take is one does not preclude the other. So CBDCs, whether at the retail level or at the kind of institutional level, right, commercial level. So the retail level, I think, would put a lot of downward pressure on banks. Therefore, I don't think that's the best solution for central banks. However, you may recall about 6 months ago, one of the Fed's payment rails went down for a day, right? That caused some chaos. A CBDC at the kind of institutional commercial level, I think makes a lot of sense. If you think right now, how many of us have an account at the Fed? Only if you worked at the Fed, you would have an account at the Fed, but 99.9% of consumers do not have an account at the Fed. However, it would modernize the Fed payment rails. Therefore, I would see a payment CBDC being something of value to the Fed as they interact with regional banks. This is your area, Diane. You can run circles around me describing how they interact with one another.
Yeah, and I think the CBDC question is a really interesting one. I know we were going to talk about some outside forces in a bit here, and that was something I wanted to raise there because I think CBDC is really different than a lot of the other private market digital assets we've touched on today, right? In this case, we are talking about, or in sort of the former, we've talked about assets that have been built by the market that are out there that can be used, sort of financial instruments like any other. A central bank digital currency is not so much about really digitizing the dollar as it is changing consumers' relationship with the Fed. Julian, I think you put it well, right? How many of us have accounts with the Fed today? And there are a ton of different constructions of CBDC, but I think one angle that is overlooked is what we're talking about is making digital money, which today we think of as sort of bank deposits, as deposits, whether they're insured or whether they are, held in a wallet somewhere that might not be insured. Those are essentially liabilities, right? But instead, what we're talking about is making an asset that feels as much like cash is today, all of the benefits of cash and all of the drawbacks of cash in a digital form. And, one of the things that I think there are a ton of models, pros and cons. There's some really hard trade-offs around things like AML, KYC. How do you enforce sanctions, right? But I think one of the parts of this conversation that's been overlooked a little bit is what it means for our financial system and our economy. Ultimately, in all of those models, every greenback says, with the "In God We Trust," but also backed by the full faith and credit of the U.S. government, right? So that is a liability of the Fed, not sort of the bank or anywhere else. And effectively, what that will do in pretty much every model. There are all sorts of ways you can try to mitigate this, but I think all of the central banks looking at central bank digital currency are wrestling with the fact that it inevitably moves deposits off of banks' balance sheets where they are made available for sort of the money creation process to be lent into the economy and to fuel growth, moves those off of banks' balance sheets and onto the Federal Reserves where it can't be lent out in the same way. And so, whether, there are clearly a number of trade-offs to be discussed. But I think mitigating that, and in many ways it's hard to, I think we need a ton of discussion around what the impact is on, not just banks, but the financial system and our economy if we lose that sort of credit creation process.
And this is actually a segue to my next discussion, as Rob mentioned perfectly. So Diane, thank you, because this is actually where I'd like to see discussion going is changes to outside of the banking environment that are going to have the biggest influence on the future of financial markets. We're talking about centralized central bank digital currency and inclusion of a separate rail, right, for payments and things there. Outside of CBDC, are there any other large external influencers on the financial market that you see coming through? Rob, I think we have your answer, so maybe we'll shift over to Diane.
Yeah, sure. I go back to developments in blockchain, not only the role of payments, which we've talked about earlier, but in financing more broadly. And I know someone earlier in this conversation mentioned tokenization, but I think putting major asset classes on the blockchain and digitizing them so they can be divided into teeny tiny shares that don't exist today could be a very fundamental change in our financial markets. And of course, it can be done for any number of asset classes. The one I think about the most, probably in the context of banking, is real estate. That's an area that would have a significant impact on the banking market if financing were to be done through tokenization. Banks currently own about half of U.S. commercial real estate debt, but commercial real estate has traditionally been the domain of high net worth individuals or other companies because of sort of the large initial investment that's required. But tokenization sort of fractionalizes value, lowers that minimum investment thresholds, and presumably the theory is provides liquidity and a broader investment base. So I think something like that could have a big impact on banking in particular and financial markets more broadly. Obviously, it can be done on a whole host of other things like commodities, equities, bonds, mutual funds, and so forth. So that's what I think we should be looking for.
Fascinating. I've been following tokenization for a little while now, and it's interesting to really adapt it to the current areas where banks are most involved, right? And seeing it as an external force. Kate, what are your thoughts here?
Yeah, I think throughout the pandemic, the way that the labor force has changed will have a massive impact onto our financial markets. All of a sudden, employers can access swaths of talent outside of their physical location, and employees can access opportunities outside of their relative area. And so this decentralization and this broad opening up of the labor market, one, it's going to have impacts everywhere, but especially as so many people are egging to leave cities and move into, smaller towns or more rural areas, or even just getting out of like LA and New York. People are sort of interested in the smaller city feel. All of that, like that labor shift, like when you're able to work remotely, you and your money, the money you spend on rent, the money you spend on your groceries and your local economy, that moves with you. And so as the labor market is opened up, you and all of your financiers are moving too. And so there's going to be this transition of money going into smaller municipalities. And I think it'll spread out things for the better. I'm very keen on this. I think we're all, quite pleased with the working remote situation. And it's just remarkable how productive we can be. Like, it's 5 of us here having this conversation. None of us are in person. I don't think I've met any of you guys in real life ever. And the fact that we can just have this conversation and engage together, I think that is so remarkable, and the beauty of remote work.
Okay, that's very interesting, the pros and cons to a fluid workforce in terms of how that's going to affect our financial institutions today and communities and areas. And you can even extrapolate that all the way down to like the commercial real estate markets and office markets and different areas there. So it's interesting to look at and see and project going forward, and knowing that the pandemic really pushed us into something that maybe we wouldn't have seen for a little while, a much faster adoption to this model. Julian, I'll ask the same question of you. Maybe if you want to touch on anything outside of central bank digital currency, or if you want to move on to the next question.
Yeah, I was actually thinking about organizing a happy hour now that Kate mentioned it. So I think Kate actually touched on one earlier in our conversation, digital identity. I think it should be a birthright to have digital identity, same as it should be to have a bank account, right? So I'm going to bring two other items, and I'll drill down on one. One is decentralized autonomous organizations. I think that is really, really interesting. I think we're still at the outset. But the one I want to drill down on is called Internet of Value. And so think of Internet of Value as being able to exchange value as quickly and as efficiently as exchanging information. So imagine being able to send somebody some type of value, whether Diane, your example with certain financial products, or just paying someone something that you owe them as quickly as the internet. And if you look at kind of the history backing this, we've always had intermediaries, whether it was a bank was the intermediary, which was needed for the trust that Rob touched on really well, whether it was a marketplace being the intermediary, like we see right now in like the New York Stock Exchange, these type of exchanges, or even a credit card company, right? They act as the intermediary when you decide to purchase something. What blockchain, which Diane rightfully touched on, and distributed ledger technology allows is for these assets to be transferred from one party directly to another party without the middle person. And oh, by the way, during that transfer, the transfer is not only validated, but it's also permanent. It's almost instantaneous. And oh, by the way, it's on blockchain, meaning that it is auditable and it is viewable. So I think that would probably remove a lot of friction from the current environment. But the Internet of Value is what I'm the most excited about right now in this fast-growing industry.
Great. We have time for, if everyone takes just 1 minute answering this last question, and I do want to wrap up and say thank you also. I want to know how you or your organization encourages innovation. After all, it's the theme throughout today's panels. So if we could start with Julian and got just a quick minute on how you or your organization encourage innovation.
1 minute. So we have first a dynamic team of product leaders and innovators that operate really at the cutting edge of blockchain infrastructure, while giving out a Circle account, which is totally free. And so when you think of operating on numerous public blockchains, it offers a really rich developer community, a rich ecosystem for individual to be able to build on an open public blockchain.
Great. Go ahead, Kate, if you can go next.
Sure. So I think the best way to encourage innovation is just by talking to people with the most diverse perspectives as possible whenever exploring a topic. So I mean diverse as in age, race, gender, political affiliation, experience, everything. Operating within an echo chamber is the fastest way to stifle growth or innovation. And I have to give a shout out to the Milken Institute. We are fiercely nonpartisan. So we engage with, running the gamut from the most conservative stakeholders to the most liberal and everyone in between. And that has always produced really thoughtful and interesting dialogue. So I really appreciate that about the organization.
Thank you, Kate. Rob, if you go next.
Yeah, thanks. There's a great team across ABA working really hard to help promote innovation in banking. We're doing a lot in that space. We've put out a series of reports trying to identify markets that we think are critical to community bank innovation, identified a number of startups within those markets and existing tech companies, try to help promote sort of collaboration between them and banks. And then, we've also taken, I think, the rare step for a trade association of engaging in venture funding ourselves, trying to find tech that we think can support the competitiveness of the industry and help draw additional eyeballs and funding towards those technologies. And lastly, it's conversations like this, making sure that we are all getting together to talk about good public policy that can help promote safe, responsible innovation in banking.
Great. Thank you, Rob. And Diane, I'll have you go last.
All right. Well, to encourage innovation, we hired this guy named Sultan Medji, who you guys met at the beginning of this program. And I'm thinking he could probably come on and explain this better than I, but he is our first chief innovation officer, and he's set up this great team of drawing on people throughout the FDIC, including people like Jeff, who came from my organization to work in FBI Tech. And they're establishing fabulous programs like this one and doing all kinds of sprints and competitions and so on and so forth. And at this point, I would just pass the baton over to Sultan or Jeff to elaborate.
Diane is absolutely invited again. She's going to definitely promote our future projects going on. I'll just end by saying this. I mean, today's discussion has just been absolutely fabulous. I'm very excited that everyone has taken the time and opportunity to discuss with us their opinions and views and analysis on these different areas and really discussing innovation in the financial markets. It's such a broad category, and I hope that we put together a good, diverse group of perspectives in different areas and different sectors. I hope that everyone here continues the conversation, and I hope that everyone that's watching now continues to watch. We are going to take a quick 5-minute break, and then we are going to look at innovation in technology for our next panel. So with that, I just want to thank our current panelists and tell everyone else to stay tuned. Thank you.
Good afternoon, everyone. My name is Zanera Mazhar, and I'm the Deputy Chief Innovation Officer for FDI Tech. And I'm very excited to be moderating today's panel titled Innovation in Technology. This is the second of 3 amazing panels this afternoon. We heard from Jeff and some very esteemed panelists earlier today, and I'm very excited to share with you the next round of panelists. Before we begin, some quick housekeeping. This is a live streamed virtual event, so please do excuse any background noises. Additionally, we do have our event disclaimer shown on the screen, which I will highlight. While many of the speakers with us today would disclaim that their remarks are their own and not necessarily those of their company or agency, we too preface the event by saying that we do not necessarily endorse or agree with all aspects of our speakers' views, but we certainly welcome and invite today's conversation. All right, now that that's out of the way, let's kick things off. We have 5 outstanding panelists for this discussion, and our honored host, Sultan Megji, will also sit in the conversation. I'll start by asking our panelists to introduce themselves, starting with Sylvia.
Hi, everyone. I'm Sylvia Burns. I'm the Chief Information Officer of the FDIC. And we have been in the midst in the FDIC of a massive IT modernization. And part of that is helping our business partners in our divisions and offices modernize not only their IT systems, but even just like thinking about how they're doing their business and really having IT support them in that as really partners. So it's very exciting times in the FDIC.
Great. Thank you, Sylvia. We have Jabri next.
Thank you. This has been this is great. I appreciate the invitation. I'm Jimmy Lenz. I am with Duke University School of Engineering. I run two of the graduate programs here. The Master of Engineering in Financial Technology seems very appropriate, and the Master of Engineering in Cybersecurity. I came to academia after about 25 years in industry in finance, and so this is always exciting to have the opportunity to participate with a regulator, but also with colleagues.
Thank you, Jimmy. Vivian?
Everyone, I'm Vivian Young, the Chief Digital and Technology Officer, Group Executive for Fremont Bank. I manage the digital channels areas, IT technology, project management office, and data analytics for the bank. Fremont Bank is a full-service relationship community bank headquartered in Fremont, California, so I'm happy to be here.
Thank you, Vivian. Arnab?
Thank you so much for inviting me to this panel. I'm Arnab Banerjee. I am right now a faculty at Purdue University College of Science, and I also serve as a guest scientist for the Quantum Computing Institute in the Computational Department of Oak Ridge National Laboratory. So my role here is actually to bring in some of the most innovative technologies in the realm of not only science, but also in finance. And we have a lot of work which is going on in that realm.
Great. Thank you, Arnab. And last but not least, Martin.
Thank you, Zunera, and it's good to be with everybody this afternoon. My name is Martin Henning, and I am the Deputy Director for Operational Risk in the FDIC's Division of Risk Management Supervision. So I'm actually pinch hitting for Doreen Eberly, who had a last-minute unavoidable conflict. She's the director of that division. But the Division of Risk Management Supervision examines banks and service providers for safety and soundness. So that'll give you some perspective. I think it'll be a slightly different perspective than anybody else on the panel, but I'm very glad to be here and appreciate the invitation. Thanks, Zanira.
Great, thank you, Martin. All right, let's get started. So during the past almost 2 years with COVID and a lot happening, and Sylvia just talked about transformation happening internally in FDIC and so many changes happening in the market, what does everyone see as the most innovative technology in the financial services sector? We can start with Martin. Why don't we start with you?
Sure. We talk about this quite a bit, and we look at the pace of change and the impact of technology on financial services. And this statement isn't to diminish the pace, because it's incredible. But one of the things I would say is innovation in banking is not new, and the technology and innovation that's transforming financial services in many ways has been going on for a long time. The examples I wrote down: advent of mobile apps, for example, machine learning. But you go back further, examples of finance and banking evolving by adopting new technologies to improve access and better serve customer needs certainly do not seem innovative now, but were at the time, including things like securitizations. The FDIC even used securitizations, which really has a lot more to do with data maybe, but an innovation in its time during the S&L crisis. ATMs, automated teller machines, a way to get funds out. That was incredibly innovative at the time. ACH, automated clearinghouse, transfer of money, credit and debit cards, internet banking. I don't want to be too forward here, but these are all changes probably in the lifetimes of the panelists, and each of them, as they came to the fore, were pretty dramatic improvements, I think, in all of those cases. Drawing on my experience and your particular question, what are some recent examples that I see in terms of recent innovations and related to operational risk? I'm very interested in supply chain and the availability of digital information and the availability of computing to explore supply chains, the provenance of software, the ownership of companies. There are any number of companies coming online with solutions that rely on digital information, the processing of that, things like machine learning, to help companies understand their supply chains in ways that just weren't feasible previously. And then another thought that I wrote down in relation to this question was multi-factor authentication solutions that are getting better and better. There have been multi-factor authentication solutions for a long time, but they're getting better and better. I listened to a presentation by a company recently that's using the channel for Amber Alerts to provide a second factor of authentication to secure a transaction. I would have never thought of that. A really interesting application of technology. So those are a couple of thoughts that come to mind.
Great. Thank you, Martin. Arnav?
So during the pandemic, I think a lot has changed, and it has almost upended our lives in several ways. And so I think that in ways, the way we thought about banking and finance before pandemic and the way we will think after pandemic, there is a complete phase transition that we will see. So I will give two different things that happened in the technology sphere. One that I see myself in, and I think is a good example, and one which is what I see is happening with a big tech company in the realm of quantum. So the first one is really what I see is the expansion of the reach of the retail social investment platform and bringing it to our homes. So, and I'll tell you why that I think that is so important. So we have this time when a huge generation of people have just retired. Of course, we know that a lot of people even retired early. And then more and more people are staying at home. And so we have two different ecosystems. One is the home ecosystem, which is a social ecosystem. And then the other is the banking ecosystem, which is a professional ecosystem. And now both these ecosystems are scrambled. And that has major implications for how we see banking going forward, how we see investment products going forward. And when two ecosystems merge, what is going to happen is that banking has to take the advantage of the social ecosystem, and society has to take advantage of the banking ecosystem. And it almost has to happen in an organic fashion, and some of which we are already seeing. And one example, and Kate Goldman already brought this up, but one thing that we are already seeing is that we are going from a bank-centric model to a payment-centric model. I will even say that we are going to a socio-payment-centric model, where we will see that the lines between the social networks and the banks will basically blur out. And what is going to happen in the meantime is that there are platforms such as I use, for example, Weibo. What really is happening there is that I am able to buy a certain Bitcoin or something, some blockchain product, sitting at my home and discussing it with my wife and my daughter while cooking. And this actually makes a huge point that how many people are really participating in the market at the same time, and that completely changes the dynamic. And that is, I think, a really new product. It's a combined product, but that's what I think is going to come. And the other thing that I would bring up, and this is not related to fintech yet, but I think it will be, is that Google announced that it has reached quantum supremacy in one of its quantum computers. And I think that was a huge announcement. Sorry, I'm getting some sun on my screen. But I think that there was another innovation which happened also by Google, which they almost slid under the rug, and they did not talk about it so much. And that is basically, they have a new type of way in which they see the quantum information playing out, which is in a distributed fashion, just like Bitcoin or just like blockchain. And in that way, the information is a lot more robust, and they can do a computation in a very different way, which I think is going to come and is going to affect fintech in the future. So those are the two things I think are happened.
Yeah, no, Arnav, that's fascinating insight, and there's so much to talk about. But before we jump, let's get everyone else's perspective too. So we'll go to Vivian next.
I'll take a little bit more of a financial services lens on this, just because I'm in banking. But with digital and technology, it's just been vastly accelerated, demanding re-innovation, reinvention, just amidst this COVID pandemic. So we've seen a lot of innovation, operational resiliency. I know, Sylvia, you could probably appreciate this, but just operating in the pandemic, pivoting quickly to enabling the employees to work remotely in a hybrid model. It's not easy, really, from a technology perspective, doing that pivot, utilizing technologies like virtual desktop infrastructure, being able to have the remote access, the monitoring tools, and then the rapid adoption of cloud technologies, the software as a service model, and how do you enable that innovation with other companies and really partnering with companies to really bring in those capabilities to market for your clients. A perfect example for banks is like with Fremont Bank, being able to support clients and prospective clients during Paycheck Protection Program, PPP, to service businesses in those tumultuous environments and times where they did have lending needs. So being able to partner with a software as a service model to do that and enable that for our clients was very important. And, different financial institutions reimagined interactions that banks had with external clients, internal staff, keeping connected during the pandemic, just like we're keeping connected virtually. Connectivity and relationships just take on a new meaning. You don't have that physical face-to-face interaction anymore, so it needs to take shape in a variety of different new ways, just like we're doing, like I said, today here. And then I would say that lastly is the flexibility of the new ways of thinking on how we plan and deliver that quality service to our clients, who might not be able to physically be able to interact with us in branches, as an example. So we partnered with fintech companies to be able to provide secure video banking, co-browsing capabilities, digital chat services for our clients. So it's a digital connection, with a human touch. And that's kind of what we talk about at Fremont Bank. It's being able to connect with somebody, even though we're not physically together, we can virtually be together in that environment. And I think banks are truly looking at that innovation, reinvention, and trying to make sure that they're able to support their clients' needs. This is across all industries. The landscape's changing, and it's just constant change.
I love that, Vivian. Digital connection with human touch. I think there is so much, again, there, and we talk about that within FDI Tech as well all the time, how to continue to connect those dots. So let me go to Jimmy and get his take on it.
Yeah, it's to your question, in the last 2 years, I would say there are two things. The first, DeFi, decentralized finance. It is being embraced worldwide. This isn't a U.S. or Western phenomena. It's changing the competitive landscape once again for financial services. Not a fad. It's not going to stop. So I would say, we need to, people need to learn about it. People need to kind of embrace that side of thing. But decentralized finance is not slowing down. It's the growth has been tremendous over the last 2 years. The other thing I would think is a change in the financial services business model, very similar to what Vivian just said. Everything didn't fall apart. We don't need to be in offices. We were able to. I hear about the operational risk and the some of the things that have facilitated it, but the fact that we were able to do it in basically a month, move everybody at home, and basically leave them there if they wanted to stay. Those are two tremendous things that would have never been imagined. Oh, we can't do this. We can't let people work from home. Certainly we can. We're running the largest mutual funds in the world, basically from people's basements. We can do this. So the fact that change has to be forced is sometimes, that's going to be happen. But it also kind of shows what I would say is a pretty much a lack of imagination in a lot of the very traditional financial services companies. The fact that people couldn't see this or couldn't imagine it until they were forced into it. So those two things, I think, are really dramatic over the last 2 years.
I agree, Jimmy. It's amazing what disruption can make you do, right? So that's great. And last but not least, again, Sylvia.
Yeah, thank you, Zanera. It's been great listening to the other panelists, and I was thinking about that Arnab, some of what Arnab was saying really resonated with me. I think for me, the thing that was most impressive is the virtual elimination of the friction between the point that you decide, like from a consumer perspective, the point that you decide that you want something to paying for it like immediately and getting fulfilled. I mean, I can go to Costco and with the same day delivery stuff, like for the groceries, you know, I could sit anywhere in my house, go onto the app, say, you know, these are the groceries I want, and I can schedule the delivery to come to me at a time that I choose. And I can pay for it, tip and everything, and boom, you know, within hours, it's like at my front door. I mean, I think that to me was from the experience with the pandemic was kind of the most you know, eye-opening thing that we went from you know, I would say 20 years ago, I used to work in international trade, and I was working on developing kind of this virtual catalog, right, to help U.S. exporters promote and sell their stuff. And I just remember how we were struggling with the little images, right, of things to put up on the web. So maybe we were pioneers, I guess, at that point trying to do that. But 20 years later, I mean, you move from that has just gone light years forward, right? We're able to take this completely seamlessly from the moment of, you know, capturing demand to paying for it right there and then, you know, getting fulfilled. I think that's quite remarkable.
I agree, Sylvia. I agree. So moving on to the next question and kind of tying it to what you said, with millions of customers and what seems like endless points of data, financial institutions are one of the most data-intensive organizations in the global economy. What role do you see big data and advanced analytics playing in how financial institutions interact with customers, and what technology do you see being most leveraged? And Sylvia, I'll go back to you, see what your thoughts are there.
I think it's all about prediction. So leveraging these massive amounts of data, from I would say all variety of sources. So I wouldn't limit what the source of the data are. To basically kind of use it to predict any number of things, from the, you know, where is my risk, to also like what is really going to be the next thing that captures the imagination of the consumers of the marketplace. So I think it's all about data, and I think some of these advanced analytical tools are going to help organizations to just kind of take a whole different approach to how they look at running their business.
Great, thank you, Sylvia. Jimmy, I'm going to go to you. What are your thoughts?
Yeah, so you are certainly correct. Banks and financial institutions are large repositories of data. They have been for a long time. I think that building a little bit off of what Sylvia said, I think it's everything else. That's you know, partially one dimension of what we use data for. So we've already found that in any sort of customer interface or anything that we want to forecast, that the use of, you know, other data tends to be much more valuable, often much more valuable. Partially that's because of the fluidity with which newer companies or different companies can use data, the computational techniques and things like that. And then a lot of it has to do with some of the constraints that I think traditional financial services companies have. And when I say constraints, sometimes these are you know, computational constraints or operational constraints. Sometimes there are constraints around the data they have, but most often there are constraints around the way that these places think. And I think that's probably the most difficult one to overcome. So I think that, data, we will certainly use data and some of the data that's generated now, but I think it's the everything else data that will be used to facilitate a lot of the things that are out there. We're constantly being assaulted by that, and we're constantly seeing that, and we're seeing a lot of new tools, right? We have Google has some machine learning things. Microsoft has machine learning things. These tools are becoming more and more available. That said, I think they're often put in the hands of people who have little understanding of what they truly reveal. I work with people quite often, and I'll ask them basic questions around the econometric or statistical validity of what they think their findings are, and they don't even understand my question, much less the answer. And I think that's a little bit dangerous. Sometimes putting tools in the hands of people who, not through any fault of their own, they just don't have, they haven't had the training and the experience, the education to fully question some of the things that, some of the findings and things like that. So while I think this data is that banks hold and financial services companies hold is extremely valuable, I think there are a lot of other data points that are sometimes equally or more valuable. But I am very concerned about some of the use of tools and what people purport to find in some cases, not having the ability to understand how to detect certain bias or even how to question results because they're just not, they just haven't had the experience of being able to do that.
That's great perspective. Thank you, Jimmy. Vivian?
Yeah, I mean, I agree with you, Jimmy. That it's an immensely exciting area with the big data and data analytics, but it also must have management and extreme care and great care with the data. So, the thoughtfulness about master data management, how the discipline occurs, working with the business and technology areas to ensure the uniformity, the accuracy, stewardship, semantic consistency across the enterprise's shared master data assets. I mean, I can't stress that enough. I think that's one area of being able to make sure that the vast amounts of data that a bank holds, we're stewards for our clients. And we have to take great care with that. And then added on is the external data factors that come into play. You hear about data aggregation and all sorts of data holding and data centralization that occurs with all of the different companies, which then, if not great care is taken, that's when you have hacks, breaches, and so on and so forth. So I think fundamentally, that is a very important concept that each company must make sure to be that steward for the clients. The role I see big data playing and advanced analytics is, how does the financial institution interact with the customer, providing that first-class personalized experience for the customers to me would be just of utmost importance, having that full picture of the customer, understanding their preferences, behaviors, and patterns, but ultimately it's to make their financial lives easier so that they have choices and options available to them, and that they're financially just understanding all of those options that the bank can offer. And then surprise and delight. Who doesn't like to be surprised and delighted about an experience that you have with your financial institution and a service quality that you really didn't expect. And then as far as technologies go, there's so many different vast amounts of technologies in big data and analytics. So, a few of them is like Hadoop, Spark, Kafka, MongoDB, and many more. And then I think we're seeing even just data warehousing as a service, right? This is, again, when we're talking about cloud-based solutions, again, great care. What does that mean to us? How do we secure the data? There's, you could probably go through a whole day worth of activities just talking about that. But I think those are, considerations that we really have to consider when we talk about big data, data analytics, and then really predictive analytics how confident, what's that confidence level, how long have we actually looked at the model and really trained the model. Those are other aspects around data analytics that must be kind of care and fed for as we move forward.
Thank you, Vivian. Arnav, I'll go to you next. You've been hearing everyone talk about it. What's your take on it?
No, this has been a fascinating discussion, and I pretty much agree with what has been discussed. And especially, I will bring up the point which I said once again that big data by itself doesn't mean much unless it comes with big analytics and statistical analysis, which is a point which was already brought up by you. And so two things are going to happen here. One is that we have a lot of big data, and we also have a lot of social data which is coming up. And what is going to happen because of that is these two data streams, one is the banking data stream and one is the social data stream, they have to merge at some point. And even if we don't want it, it is going to happen. And we have to be ready for that future. And when that happens, you will get completely new kinds of products where you won't be able to make really a difference between, let's say, what is a social network versus what is a banking network. And some of these, which we are already seeing probably, and I think and financial was something which was already brought up by the previous panel, where you will have platforms which are somewhat of a social network. They see what is the social network of what you have, and they can do a big data analytics on people like you, and they will be able to not only offer you products, they will be able to offer you products related to banking, and they will also steer you towards a certain kind of banking model or the other. And so this is one of the emergent aspects of big data which is coming up. And so the next question, I think, is that then what are the technologies which will leverage this most? And I would say that I think that social firms, of course, because social data is the biggest type of data we have, and then banking firms. But the most important, I think, is the AI firms that are going to be extremely, extremely important. And what you will have is basically, right now we are talking about a single layer AI, which are looking at the data and trying to extract some information. You will now have you will have multi-layer AI. So there will be an AI program which will choose between a bunch of AI programs to give you the most statistically significant data set that you would need to make your decision. And I think that that is going to completely change the kind of landscape that we have for what are the kind of offerings that we have. And I would have to say that the biggest thing about big data is that data basically scrambles the division between information, between money, between everything else. And so it will be a common offering that one have to be looking forward to, and that will be enabled by big data.
Thank you, Arnav. And Martin, this is not a conversation that's new to you. We've had this discussion many times. So what are your thoughts?
Wow, it's hard to add to what's already been said. I've got a particular piece of work the FDIC did that I want to mention before we end, but it's interesting listening to Arnav especially, and Jimmy, everyone actually using a lot of digital information to predict the differences between how financial institutions receive their data and the way the social network receive their data, how those two groups of entities in the United States treat and use the data that they have is very, very different. One of the things in the discourse right now is user permissioned. The idea that the information about my payments is not something I expect my financial institution to use for any other purpose than to facilitate the exchange of funds with a party to whom I'm giving them. So I really like the dichotomy Arnav's talking about. There are at least two different big data sets relevant to this conversation and how those data sets were created and how the companies that manage them view them is very, very different. And frankly, the word that comes to mind from the previous panel is trust. How much trust does the average consumer hopefully have in their financial institution, their treatment of that data and the use of that data versus some a company or an entity not in the financial sector. I think there's a difference there. But just hitting on this real quickly from an alternative data perspective, in December 2019, the banking agencies in the United States, the FDIC, the Federal Reserve, the Office of the Comptroller of the Currency, Consumer Financial Protection Bureau, and the National Credit Union Administration issued an interagency statement on the use of alternative data in credit underwriting. That's certainly been a fascinating area in terms of the use of big data. That statement focuses on consumer protection implications. It highlights the potential benefits and risks, and it actually encourages responsible use of alternative data. And in that statement, the agencies recognize alternative data's potential to expand access to credit and benefit consumers. And I think we've had now a tech sprint exploring some of those ideas at the FDIC. In particular, the statement highlights the use of cash flow data as a type of alternative data to determine a borrower's ability to repay a loan, which can improve the measurement of income and expenses. So an important part of that process is that consumers can expressly permission access to their cash flow data, which enhances transparency and consumers' control over the data. So the FDIC is continuing to monitor and explore the use of alternative data for many different purposes. And as we gain a deeper understanding of alternative data usages, we, along with our interagency counterparts, may offer additional pieces along those lines. I would say something Jimmy said really resonated. We need more statisticians. We need more people whose aptitudes in data analytics and statistics, mathematicians. We need to encourage those in our students because that understanding is needed at the companies that use the technologies and use the big data. There's a principle even in operational risk management where just because you're outsourcing a function doesn't mean that you've outsourced your responsibility for managing the risk. You can't do that. So in this area, Jimmy's comment really just resonates. We need to continue to encourage those kinds of studies and disciplines and experience.
Yeah. Thank you, Martin, for that. And I couldn't agree more with you and Jimmy. We absolutely need more statisticians, data scientists, and we need to encourage not just students, but I think as employees are coming in, providing them more training, better opportunities so they can explore more. I'm going to go to Martin, actually back to you, and I'm going to ask, looking at the legacy infrastructure and the push for more agility and speed, many financial companies are moving towards cloud computing. How do you see this transforming the current environment?
Well, the first thought that came to mind relative to this question is I can't imagine a bank starting today, call them de novos, and doing what a bank starting 50 years ago did, which is think about how they're going to create their data center, because they really don't need to do that today. They just hire hopefully a very bright, experienced person who works in their basement and spins up an environment and adds things to it. We've talked about software as a service. That's really amazing when you think about new companies, and there has been an increase in pace of new banks coming online in the last few years. But for everybody else, the capital expenditure necessary to start something brand new is so much lower. For brand new companies, that's a competitive advantage to companies that have a legacy infrastructure. Some of those legacy infrastructures are very brittle, and the companies that sell them and run them, sometimes off-site, are working to create interfaces and APIs, but that capital expenditure to start something new can be much lower. Companies with less resources will continue to have greater access to almost unlimited computing power that can be deployed more agilely. That just doesn't exist without cloud computing and the advances. The speed with which companies can take advantage of that power when compared to the speed with which they deploy their legacy infrastructure is just going to be so much greater. So the opportunity for innovation at companies with less resources will continue to grow, I think. In fact, some argue that the smaller the company, the less complex their legacy infrastructure, the greater ability they have to take advantage of cloud computing. So, that does come with some risks. I mentioned I work in the risk management division at the FDIC. With great power comes great responsibility. I'm not sure who said that first, but the opportunity for less technical staff to identify how technology can help them to innovate is going to continue to grow and presents particular risks. You want to encourage that kind of innovation, but you have sensitive information that needs to be protected in critical services. So, companies that use the cloud need to be cognizant of the shared responsibility, both within their organization and between them and the cloud service provider, and make sure that that responsibility is well understood between the companies. So I think those are some of the things that come to mind, Zanera.
Great. Thank you, Martin. Jimmy, I'll go to you next. Where do you see artificial intelligence and machine learning now, and where do you see it in financial institutions over the next couple of years?
Yeah, AI and machine learning, obviously they've been around for a little while. They continue to be expanded upon, but they also continue to be revised in a number of different ways. Within financial institutions, it's interesting because I see machine learning being used in a number of different ways, but they're primarily fairly limited. I would say the sales function, the marketing function, those kinds of things seem to garner most of the attention, and I think most of the resources around AI and machine learning. The areas that I think could benefit from these are areas like Martin was just talking about, risk management and things like that. Using machine learning to forecast certain things under certain conditions is a perfect example of what we should be doing with it. Sure, it's great to use in the sales function. It's great to use to suggest another product for people to buy. But when we're thinking about large-scale financial institutions, when we're thinking about how products will perform under different kinds of conditions, that was one of the things that I really enjoyed. And while I was chief risk officer for the brokerage firms, was being able to think through that. Now, that was several years ago, and the computational facilities that we have today weren't available then, but I wish they had been. But it's really cool because I think we've moved way beyond a lot of the standard measures and the things we've done. If you go to and look at any financial institution, and you look at their portfolios and things like that, what are we using? We still use risk-weighted assets, right? And those are done in a little bit of a vacuum. When you go to brokerage firms and you look at their portfolios, what do they use? VAR. Yeah, that's a pretty big vacuum. Should we really be using things with backwards-looking type of views? We don't have to do that anymore, and yet we're still constrained. So I think there are a lot of opportunities. I'm not saying they shouldn't be used for customer service and for sales type marketing functions. What I'm thinking is that AI and machine learning, there are a lot of other applications within financial services that lend themselves, I think, to a lot more of the safety and soundness and product performance, things along those lines, so that we don't have to guess anymore. We can do things with certain level of understand what the probability distribution is of certain performances and things along those lines. Again, I would re-emphasize, and Martin emphasized it too, the need for people that have the skills to do this is really important. I mean, it's one of the things, a little plug here for Duke. I mean, it is one of the things that we concentrate on quite heavily in the graduate programs that I work in, is not only do you know how to use the machine learning. Fortunately, it's one of the things that I'm giving a final in today in machine learning, and we spend a good bit of the time understanding, okay, so what's the result of this? How else can you interpret the results? I think those kinds of questions are really important. And as we lean more heavily on AI and machine learning, and absolutely no doubt we will, understanding things like bias in these kinds of things, and sometimes it's missing variable bias, things like that. Both overt and missing biases. It's really, really important for people to have the understanding on how to spot these and how to test for them.
Thank you. And I'm sure, Vivian, you have thoughts on this as well, so I'll go to you now.
I do. And Jimmy, I won't mind lending some of the talent geniuses at Duke University for our bank. So we will connect later. But really the amazing part of artificial intelligence and machine learning is that continually the ability to ingest the data, the senses, the comprehension, the acts of learning, and it's 24/7. It doesn't stop. It really impacts every part of the financial institution's operations and value chain. And I think the areas in which financial institutions really need to understand is really interrogate what parts and use cases make sense for the financial institution. It's such a vast sea of different various use cases, and it's only scratching the surface, right? When we talk about using AI and ML. I think also for financial institutions, cost-benefit analysis obviously is a hugely important factor in where to apply AI and ML, because there is an amount of time and investment in making sure to understand it. Again, like I said, just the confidence level, the learning involved in that, and then also the resources necessary to make that happen. And then, currently, the applications in machine learning and AI, process automation, cost reduction, security, fraud detection, I think is hugely important. I'll talk about that in a little bit. Credit decisioning and scoring. Jimmy, to your point, products, service offerings, those are, things we're seeing right now. And then customer service quality. So, some of the areas in service interactions with our clients is, rudimentary chatbots that you see that sometimes doesn't answer the questions. And I think it will really mature in its activity around being able to answer people's questions better as time moves on and as the technologies continue to mature. And then also, what is likely for the client to ask of the representatives so that you can anticipate those items. In addition to that is, optical character recognition. We see that in its rudimentary form with mobile remote deposit captures, now coupled with AI/ML to really look at documents, pull metadata, enrich the metadata, gain confidence about what documents and document types they are. Being able to then take that to the next level in being able to understand if that client's lending needs and the process of being able to approve the loan and having a scoring model and just being able to kind of have another factor to look at as a part of the lending approval process as an example. And then, really, like I mentioned about it's, looking at kind of risks, knowing and understanding fraud, like account takeover, opening an account. The AI/ML observes many different factors when it comes to risk scoring, understanding if they're going to be a nefarious actor in that process. And then the stronger safeguards around screening of authentication and authorization, maybe when a client actually calls the contact center. So you're seeing a lot of voice biometrics. I think there are going to be other types of permutations of that using AI and ML to really help understand if the person that's calling or the person that you're talking to really is who they say they are. And there's other different factors now, right? There's this virtual factor that we're looking at each other on a video, facial recognition, and being able to really kind of match that up with other different data and data points. So I really see those as kind of some of the areas of opportunity. Also, sentiment analysis is another area. What's the client feeling? If they're calling, what's their emotional factor at that point? Are they happy? Are they distressed? There's some areas there coupled with a lot of different other data that we could be doing to better help service the client. What are the endpoints? What are the different touch points that the client has had with the financial institution? Did they go to the branch and then they went to the contact center and they're trying to call? Who knows? Maybe this might be a metaverse situation later on down the line, right? There's other different form factors. So I think artificial intelligence and machine learning, we're just totally scratching the surface on it.
Great, thank you. Thank you to both of you. I'm going to turn this to Sylvia and Arnab now to talk a little bit more about, as we enter the phase of quantum computing, where do you see the areas with the biggest risks from offensive quantum computing threats, and where do you see the biggest opportunities for quantum analytics in terms of use cases when compared to classic machines?
Well, if you want, I can get started.
Yeah,
so
please.
I think I'm going to guess that everybody pretty much knows that the biggest risk is around the issues around cryptography. So the fact that quantum computing can allow kind of the encryption codes, the cryptography that is around kind of the authentication schemas to basically be broken. And my colleagues at NIST over at the Department of Commerce, they're on this, so they tell us, don't panic, right? What we have to do is plan and prepare, which is, I know some of the guys over there, and that's what they're doing. I know that a few years ago, they did kind of a global call out for new algorithms for the new encryption, that would be of the future. And they're going through a process of down selecting to figure that out. They say from what I understand from them, it's not like this is going to happen tomorrow. This is going to happen in the next few decades. So we have time to work on it, and we have to use our time wisely. But I think people are. So that's the risk, and I think we're just going to trust some of the people who are honestly, they're working with some of the most brilliant minds in government and academia and industry. And, I keep my eyes on it, but I think that's probably the biggest risk. Arnab, you're the expert. So, do you want to chime in on that one, and then we can talk about the opportunities?
Sure, absolutely. So I completely agree with you that one of the most talked about risk is that of quantum encryption, and the biggest reason is the Shor's algorithm, which really can decrypt your data, especially when an encryption is used using the fact that prime factorization is hard. But if that is broken, if you can run a Shor's algorithm on a real quantum computer, then that can break all the end-to-end encryptions that we really rely on today for our security. I will basically bring up also that there is another way you can have a security vulnerability, and that is because you have heard of search algorithms such as Grover's search algorithms, which is also a quantum algorithm. And what that really does is that it really looks at a black box algorithm, like what a financial company is doing, and it can really run the algorithm in a way, if you have encoded it right, to figure out what are the inputs which are coming into the algorithm. And that is so powerful because you can actually do a complete tomography of the business model of a certain company if you have the largest and powerful machines. And so I see that that is also a risk, that can also be a risk, that because it really exposes certain organizations. And regarding this quantum encryption, which is the point which Sylvia already talked about, you already know that Honeywell just announced, in fact, yesterday, the new company called Continuum, and they will be doing quantum key distribution using a code name which is Quantum Origin. But I will also just tell you that, yes, there is still some time to come because the quantum volume right now is only 2 to the power 10 or 2 to the power 12. We need a quantum volume of 2 to the power 50 for this to be reality. We still have some ways to go there. But as we know with disruption, that sometimes there can be a disruptive technology that can just bring you there very quickly. So we have to be prepared for it. So yes, right now we are still on some of the earlier steps, but we have to be careful.
Yeah. And then if you want to get into the opportunity, I mean, I feel like we could enter the realm of sci-fi and really just kind of imagine what you could do with that kind of computing power. And so like I was watching some videos on this recently, and you know, if you think an example was given about healthcare, you know, and running MRIs, and how quantum computing could help doctors to basically process an MRI just like so much more quickly to be able to do a diagnosis and really get to the heart of whatever the problem is. So I would say like any problem that requires intense computing, I mean, the speed at which a quantum computer could go through that is going to be, you know, just a fraction of what happens today. And then I kind of, you know, Vivian was mentioning the metaverse. So for those of you who are like sci-fi fans and have seen Ready Player One, right? Can quantum computing, and I realize like hardware will probably have to change, software will have to change, but if the metaverse or when the metaverse becomes a reality, I imagine that quantum computing could have a big role in something like that. And so like, you know, right now virtual for us means that we get to be on WebEx together or Teams or Zoom or whatever technology you're using. But what if we are, you know, what if you're using augmented or virtual reality? And we've got like our avatars who are like, we are in person, we're, those avatars are really representing our physical selves, but in a virtual world. I mean, are we going there? That's, you know, I think that some are speculating that that's kind of where we're going. You know, so I think there's that, and there's just like countless problems if you think about compute capabilities and the processing capabilities that would be needed to quickly go through massive amounts of data. We talked about big data before. I think quantum takes this to a different level.
Right, and I will add to that there are quite a few spaces in which we see opportunities. And in fact, whatever is a threat, if encryption is a threat, encryption is also an opportunity. If we have the quantum keys that can really secure the data, because the random numbers that are required for you to read the data are generated on the fly. So what that means is that, yes, there is a security vulnerability, but there is also a security opportunity that comes with quantum. And in the same way, quantum actually makes it, as I was mentioning, this black box search algorithms, it actually has a lot more opportunities there as well. For example, if you are trying to figure out money laundering, or let's say you're trying to figure out one weird transaction, then that is where if you can code the quantum computer right, you can look at a lot of data sets, because you can put in it can crunch all the data sets parallelly. You can actually figure that out pretty quickly. Correlations between data sets, is it a spurious correlation or is it a real correlation? So that's basically something where, again, it will require the right algorithm development, but is important. Non-equitability between data sets. Are two data sets equitable? Are two algorithms or two offerings by companies equitable or non-equitable? So that, I think, it can be a great example. And last but not the least, there is quantum machine learning, where we take the same tenets of machine learning that we have been talking about so much, but we can take one more step into quantum machine learning, where we would have an invisible layer of qubits which we can use in order to vastly improve the kind of operations we are doing. So these are all the opportunities which basically await us once we get there.
Thank you, Arnav, and thank you, Sylvia. That was great insight. And I know at FDI Tech, we're definitely looking at basically the risks and how to, set up a panel and make sure that we continue the discussion on quantum. Sylvia, we know that we've been interacting with your shop, so very excited to continue these conversation. We have 1 minute left. I would ask everyone, in 10 seconds, if you could tell me, looking ahead 10 years, what technology do you think society will be using to transact in general commerce? Are we leaving our physical wallet in today's terms at home and using only our digital wallet, just our phone, or something else? So I would like to go around and ask you guys quickly, what are your thoughts?
I want to say that haven't we I think large swaths of the population have left their wallets at home and they're working digital, right? They use their phone or their watch, right, to pay for things. But I also have to say that I was at the supermarket not that long ago, and there was an older couple that was in front of me, and they pulled out their checkbook. So I just want to say that, the reality of the world is that, like, probably there's going to be a lot of things going on. Maybe like what I hope for in 10 years. And I know this is kind of maybe also a little bit in the realm of the far future. Hopefully not sci-fi, but fusion technology. So because clean energy is just such an important thing for our society, for the world at large. And we'll see what happens.
Yeah. Great, thank you. Anyone else has any quick thoughts? All right, well, thank you everyone for today's time. This has been absolutely great. I would say that the first panel decided to have a happy hour, so we should definitely decide and continue to have this conversation. After this panel, I thank everyone who's watching. We will go straight to a 5-minute break and we will be back with our third panel shortly.
Good afternoon and welcome everyone to today's FDI Tech event. Specifically, joining us now for our Innovation in Diversity, Equity, and Inclusion. I am Isaac E. Hernandez and currently a member of the FDI Tech team here at the FDIC and your moderator for this panel. As it was mentioned earlier, we love our panelists and the views discussed and the views discussed and the ones that will be discussed today are the views of the panelists and not necessarily reflective of the FDIC policy or position. Now that I got that out the way, I want to share that as I am attached to all the topics in today's event, diversity, equity, and inclusion is near and dear to my heart and passion. As throughout the event, we have a phenomenal panel, and I'm excited to get their insights on how technology innovation impacts diversity, equity, and inclusion, or DEI for short, as that can be a tongue twister. And what better way to introduce our panel but to have them introduce themselves. But before we do that, I'd like to acknowledge our Chief Innovation Officer here at the FDIC, Sultan, who I know is tired. He's had a very busy schedule. He's been all over the place. So Sultan, any words of encouragement and thoughts before we start?
Well, first off, I know that like many others, I was watching the last two panels and just sitting in the background. They're absolutely fantastic. And you guys the bar has been set very high for this discussion. So with the five of you here, I'm incredibly excited for that. DEI as a topic is something that, a few years ago, we never talked about it at all. And now it is front and center in every discussion, and putting it as one of the top three topics we're talking about on the very first event like this that we're hosting from the Tech Lab, to me just puts a stake in the ground and say, listen, we've been listening, we've been hearing what people have said, and we realize this is a critical conversation that has to be part of everything we do. And I could not be more excited to hear this panel with some of my favorite people, which is a direct quote from one of our panelists, who sadly I did not wear a tie for today, so I know I'm going to get in trouble on that at some point. But with that, I will turn it back over to the rest of you. I am so thankful for you to be here. This is going to be an awesome conversation, and I'll let you guys go.
Outstanding. Thank you, Sultan. You're so motivating. So let's get to know our panelists, shall we? So we're going to go in order as I see them on my screen. So we'll start with Catherine, Faith, Thomas, and last but not least, Nikita. So Catherine, and I know you're like to be called Kat. So Kat, introduce yourself.
Thank you so much. Well, it was wonderful to be here. My name is Kat Berman, and I am CEO of C-Note. So we are a woman-led fintech platform and social enterprise. And our mission at C-Note is really to address the racial wealth gap through the power of financial innovation. That means to us by really connecting incredible mission-driven deposit institutions like CDFI banks with this incredible universe called impact investors. And by impact investors, I mean everything from corporations to foundations to individuals. This group of impact investors have pledged trillions of dollars towards wonderful social projects. And at C-Note, we believe that mission-driven deposit institutions are on the ground doing the hard work every day and should absolutely get access to the capital, the support, the growth they deserve by working with impact investors. So that is what our technology platform does, and excited to be here.
Thank you, Kat. We're excited to have you. So Faith, you're next. Introduce yourself.
Hello, good afternoon. I'm Faith Bautista. I'm the CEO of the National Asian American Coalition and National Diversity Coalition. Every time I get asked to speak on diversity, equity, and inclusion, I immediately raise my hand because this is so important topic. And I just want to thank FDIC for having this workshop. I cannot emphasize enough that this is it now. Everybody should be part of this beautiful country. So looking forward to the discussion. Thank you.
Faith, you touched me there because I think the same way. Thomas, your turn.
Thank you so much. Really appreciate the opportunity. My name is Thomas Foley, and I am the Executive Director of the National Disability Institute in Washington, D.C. We are the first and only disability organization that works exclusively on issues of financial inclusion and belonging for folks with disabilities. We do that through policy, research, demonstration projects, and consulting with the private sector, with the public sector, and the disability community, trying to be a bridge between all those groups, bring everyone together to improve financial and economic outcomes for people with disabilities and their families. It's great to be here today. Thanks.
It's awesome, Thomas. That's awesome. Thank you for that. And last but not least, Nikita.
Isaac, I thought we agreed I like to be called Beyonce, and you're going to call me
I'm sorry.
Beyonce.
Last but not least, Beyonce.
No, you're catching. So seriously, when I'm not making hit records, I'm just kidding. So my name is Nikita Pearson. I am director of the FDIC's Office of Minority and Women Inclusion. And in my day-to-day work, my responsibility is to promote diversity, equity, inclusion, and accessibility at FDIC's workforce. We have over 6,000 employees. Among our regulated entities, we're the primary federal regulator for 3,000 plus banks, and also within our business operations. And that means our procurements and contracts that are multi-million dollars each year. So those are my primary responsibility. Happy to be a part of this discussion. Diversity, equity, inclusion, accessibility, near and dear to my heart. And then I have the wonderful opportunity to be with this awesome panel. So thank you for having us today.
Awesome. Thank you all for introductions. So let's get to it. And Nikita, you went last, but I'm going to pick on you first because you and I have had plenty of DEI conversations in the past. I would love for you to jumpstart this discussion by asking you the first question. Is that okay, Beyonce?
Oh, all right.
Awesome. So looking back, let's look back almost 2 years. Actually, we are in our third winter now of the COVID-19 pandemic. And, there was that technical push to quickly push to a virtual working environment across all industries, and of course, including the financial sector. What are some of the pros and cons remote work has in building a more diverse workforce? What say you on that?
Yeah. This is such an important question, and I'm on the firm belief, like now I'm drawing a blank on who actually said it, like you never waste a good crisis, right? And so I think that remote work options really created opportunities for most direct workforce in like 4 primary different ways. The first is that it fostered inclusion, like remote work that was supported by technology. It really eliminated or significantly reduced like commute times and other forms of travel. So less travel allowed individuals who are caregivers or had responsibilities that required them to be closer to home, really provided them with a better work-life balance. In addition, if you think about people who may be economically disadvantaged or lower incomes, they were able to save money because, they spent less on work-related expenses like commuting expenses or wardrobe because they might not necessarily be dressed in the same way as if they were going into the office. And really, surveys also report that remote work fosters inclusion because minorities report improved workplace satisfaction because they experience fewer in-person interactions where microaggressions were more common. So really, remote work helped promote experiences that increased employee satisfaction and engagement. The second way is it is improved accessibility. So remote work really increased the use of virtual meetings and like the meetings we're having here today. And so technology like voice transcription tools and things like that really better supported employees. For example, those who are deaf of hard of hearing, particularly when we have impromptu meetings, they were better supported. Third is it promoted career development. With remote work, organizations were able to send employees to really a wide range of educational experiences. So more people could take advantage of developmental opportunities and training regardless of the location. And actually this virtual training, the quality of it often was enhanced because they weren't competing with dedicated in-person learning and the resources associated with that. And fourth, it strengthened talent management. Remote work really enabled employers to recruit from a broader applicant pool. So really, employers and applicants had more opportunities to connect through virtual career fairs. Isaac, you and I have done many. And even though our workday had many meetings, we were able to jump into recruiting events and things like that. So really just having an opportunity to connect with the applicant pool you may not necessarily be able to do. But with that, there are also some challenges with remote work. Remote work really exposed the gaps in reliable, fast internet services in rural communities or in households that could really only afford basic service. And it also exposed that women continue to shoulder the majority of family caregiving responsibilities. and more frequently reducing their hours or leaving their jobs entirely because they're trying to balance both sets of responsibilities. And for organizations that really heavily relied on in-person interactions, some struggled to capitalize on the added value of diverse talent because for their structure, remote work really hampered their spontaneous learning and creativity. So with that being said, like my personal view is that there are more pros of remote work than cons to building diverse workforce. And with the help of technology and intentional effort, we can really find innovative ways to address these challenges. So Isaac, I'll really lead the audience with a bit of advice in the form of my favorite quote. One of my favorite quotes: "Don't be afraid to try something new. Professionals built the Titanic and amateurs built the art." And what we know for sure, the financial services sectors, there's a lot of room to strengthen diversity, and we can use this at new and innovative ways to accomplish this.
Wow, see, I just knew that you were going to jumpstart things. Look, I bought this tie because of this, because I saved some money from commuting. But, anyway, anyone on the panel would like to add on that? I know usually on panels with Nikita, I try to hit the unmute button before she does so that I don't have to follow her. But, anyone on the panel would like to give, any additional piggybacks or any comments on what she said or the question itself, any pros and cons that you feel that wasn't discussed yet?
Yeah, I can jump in briefly. I loved everything Nikita said, and I would just echo that idea of connection points that perhaps would not have happened organically, but now happen more seamlessly because of technology. We saw a few examples of that happening as it relates of just economic opportunity. So there's so many folks that don't get key job opportunities simply because they don't run in that right network. And often that's because you don't go to that same, sports facility, or you don't run in that same pack. And that is so limiting. And that is absolutely part of what contributes to the bias across the country. But when you flatten that and have all of us online doing Zoom and WebExes, that ability to send someone a note or a LinkedIn, or actually the opportunity to connect with them, those barriers go down significantly. So I would just echo what Nikita said. I think we are seeing greater access and greater openness to connections that may not look and sound like you because of the influx and the intentionality around our use of technology.
Very interesting. That is a fascinating point there. Anything else, anyone? Because I really like to go to Thomas, because as I'm listening to this conversation, I couldn't help to imagine viewing this through the lens of the demographics that Thomas serves. So Thomas, I'd like to ask you another question that's related. So, because as the executive director of the National Disability Institute, how have you seen technology leverage in this virtual workforce environment, and specifically, in what ways has it helped push forward and support your mission, or introduce potentially new challenges in this virtual environment, specifically to the demographics you serve?
Yeah, thanks for the question. It's been ground changing in a number of ways, and I think Nikita really hit on an important issue. People with disabilities, in particular, working from home just works better, right? They don't have to commute using a wheelchair. I'm blind. They don't have to deal with construction, right? So working from home, interestingly enough, is something that folks with disabilities have been asking for literally for decades, right? And that was made possible by technology. And for the most part, the answer, except for, more progressive organizations, has always been, well, we need you in the office. It has to happen in the office. We don't work from home here. And obviously, all of that changed, 21 months ago. And all of a sudden, working from home became a lot more viable. And so today's meeting is just so perfectly placed, because some disability employment data came out just recently that we are at the highest level of disability employment participation in the history of the United States. The last high was in 2008, and then there was the Great Recession. But one of the things that we've seen is that, now that people with disabilities are able to work from home, and they're able to, work from home with just as much effectiveness as everybody else, that folks with disabilities are flocking to the workforce. And, you've probably seen that, some people are taking a step back from work And we have a group within NDI called the American Dream Employment Network. And we help people with disabilities who have been separated from the workforce find work. And we were shocked that in 2020, we had our best year ever. And now in 2021, we've had an even better year. We have employers coming to the American Dream Employment Network and saying, hey, folks with disabilities are really contributing to my job. Can you help us find a few more? And so, it has absolutely been revolutionary. Now, mind you, folks with disabilities are still nearly 40 percentage points behind when it comes to workforce participation. But because of technology and because of things like Zoom, they have, access to things that, and the ability to work, and especially in a more flexible schedule, just as well as anyone else. The one piece we are also seeing is obviously this means that technology has to be accessible, right? So again, I'm a blind guy. I use a thing called a screen reader that you're going to maybe hear from time to time. And so, not all interfaces are created equal. Accessibility is something that you have to build in from the very beginning. You have to update it with new versions. You have to make sure that it works with screen reading software. Or whatever setup a particular person has. And it's funny because things like Zoom and WebEx are pretty accessible, but sometimes people really forget about some of the other things we deal with. Like is the expense reimbursement software that we went to in April of 2020 very quickly, is that going to be accessible? Is our new timesheet software going to be accessible? So it's really important that when people are thinking about this and when one is looking at dealing with new vendors and new technology in the workforce, that we think about accessibility, so that as many folks with disabilities as possible can work from home. One of the interesting things about doing DEI work is that disability has been really focused on more and more in the last couple of years. And folks with disabilities are making, great strides to being employed at greater levels. But there was a word Nikia used that I really wanted to highlight again. It's intentional, right? We have to be intentional around accessibility, intentional reaching out to people with disabilities in a work environment, and intentional in our hiring practices as well.
That is fascinating. I had a conversation with someone who has a disability, and she actually echoed a lot of things that you were saying about the inclusion aspect and the allowance of using technology to have discussions. So I appreciate that fascinating connection for me, to connecting the dots. Anyone else would like to add to what Thomas mentioned there?
Yeah, Thomas, number one, this is Faith Bautista. Thank you for your work. I really appreciate organizations helping people with disability and working from home, and being in minority groups, immigrants. A lot of them cannot drive, and that's one of the reason. I mean, they're just not used of driving. They just cannot go from one place to another. And now, because of this technology actually, and encouraging working more from home, Nikita, I also want to add on that we have produced, I would say, 3 times more since pandemic. People, we hire more, even just the part-time people that cannot go to work before because of that disability, and now they can. Everything you can do, actually everything via Zoom, and people are just so used to it now. Even from their iPhone, right? They can, the messenger, that the video that you can talk to, the counseling that we're doing, and a lot of this are hand-holding approach. So now they don't have to go to our office. We can actually sit down and talk to them more. And a lot of them, even some of our staff that have a hearing problem, it is now easier because the speaker is on their head. They can hear the client better. So I just can't believe that technologies really changed on the and not just service disabled veterans also, right? But this is really for disability. So thank you for what you do.
No, that's awesome, Faith. As I listened to the conversation, I also thought of closed captioning, right? Which has been around for years, but with the advancement of technology, with voice recognition, artificial intelligence, machine learning, it has evolved over the years to be as accurate as possible, regardless of the language spoken or despite even accents. Some of the audience today are most likely using closed caption to enjoy this event. And let me tell you, I'm originally from New York. I speak with my hands and I speak fast, so I'm hoping that the software is actually keeping up on this. But this brings up an interesting point, because if we have time later on this panel, I'd love to ask the panel a specific question around artificial intelligence as it goes to DEI. But moving on, I would like to move on to Kat. I love saying that. Catherine. How you doing? So your company, by the way, I love the name. It's very clever. As you mentioned earlier, it's an impact investment platform that utilizes technology to unlock diversified and proven community investments, specifically to increase economic mobility and financial inclusion. We talked about inclusion. Thomas talked about inclusion with people with disabilities and provided some statistics as well, which I wanted to look to your thoughts on specific statistics. So according to the US SIF, the Forum of Sustainable and Responsible Investments, their latest biannual trends report shows that total impact investments assets under management in the US grew 42%, I believe, from 2018 to 2020. What role do you think technology had in this specific growth, and how does the trajectory continue in the next biannual report for 2022? What's your thoughts on that, Kat?
Absolutely. Well, it has been exponential growth in impact investing over the last few years. And 2020 was actually a banner year for impact investing. So I think the headline is we're just going to see more of it. And I'd actually say that there are kind of three key things that have driven a lot of that growth over the last 3 years. I would isolate them as education, access, and performance. And I would posit the technology played a role in all three. Let me just take performance. Certainly the ability to monitor what an impact investment has actually done, what the risk was, what the performance was. That ability has been sped up with market adoption and with the advent of technology solutions. The first I mentioned, education. Likewise, as Nikita was sharing, learn, explore new opportunities, understand what even is an impact investment, and what is the continuum as it relates to risk and return. So that education piece really opened up with the opportunity to meet and greet and learn via platforms like WebEx and others. But I'd say the piece of it where technology, I believe, played the biggest role in terms of driving forward more investments was really access. Prior to technology and kind of the more manual processes around impact investing, it was really hard to do things such as identify what even is an impact investment, underwrite it, package it, securitize it, and then where are the platforms to get it to you, right? I mean, there used to be a lot of faxing and copying that needed to be done to actually get documents to one another. I think with technology, what we've seen is so many incredible platforms and products have come out to make it easier for investors interested in aligning their values with their portfolios or their dollars to learn, to make those decisions, to frankly move dollars from the comfort of their own home and to track that performance. Again, all using the power of technology. So I certainly think education, access, and performance really drove that growth. And I think technology played a key role. More specific, I would just add for this audience, as we think about FDIC and we think about deposit institutions, the areas that we emphasize at CNote are really community finance and mission-driven deposit institutions. One of the areas that we saw prior to some of this technology was this idea that those impact investors who wanted to, let's say, join or become a client of a great mission-driven bank, right? Really believed in their local community bank. Oftentimes, they really struggle with getting information or really struggled with understanding, how to work, how to sign on, different account structures, or if they wanted to support the bank in a different way. Maybe they wanted to think about a philanthropic or different type of support structure. how to do that was very complicated and very manual. As we look at things such as what we're doing around needs-based automation, we're really able to leverage the power of technology and data to better understand how we get from an impact investor that wants to move money or be part of a mission-driven bank to the action of actually doing it and supporting that bank or joining that bank in a way that's really meaningful for that institution at the right time in the right place. So I think on a good note, we're just seeing more the power of technology being driven for very good purposes around deepening the opportunity to support a diverse array of banks, but also really drive greater financial inclusion with the power of that technology.
Well, I'll tell you what, you gave me some flashbacks when you said faxing. I remember when I first bought I was blessed to buy my first house, and we had to fax all the information. But one thing I love right now that's like better than sliced bread is the electronic signature and the security behind it, which is awesome. You can just click, yep, I sign, I approve, boom, and it goes. So that's thank you for that flashback. I'm feeling much better now. And awesome. So any other thoughts on what Kat mentioned on this? I mean, it's fascinating the information that she was providing there. Anybody want to jump in on this? Yes, no? Everyone's going twice, because that's awesome. Because, by the way, I want to say, Kat, I love the focus and work on financial inclusion specifically. And speaking about inclusion, I like to go to Faith Bautista, to be exact. I said that in purpose for the closed caption people in Spanish to see if it catches up with you. For everybody's awareness, Faith was on one of the teams that won the recent FDI Tech Sprint on inclusion, which was designed to help banks meet the needs of unbanked customers. So congratulations, Faith. And Faith, so continuing the theme here as we talk about technology, as your nonprofit that provides, amongst other services, technical assistance services to minority and low-income populations. Faith, how do you see today's technology evolving to be used as a tool to create a more inclusive financial system, especially for the unbanked?
Well, number one, I want to ask FDIC, Sultan Isaac, that you put that competition together. When that competition came out, I thought to myself, I said, oh my gosh, we should apply for this. We should be part of it. And since then, we are so hyped up in helping the underbanked and underbanked. As a community leader since 2000 and seeing that this unbanked and underbanked and the disadvantaged community, it's not moving the needle, right? All we do is talk about it. It's every workshop, it's happening. And after this Tech Sprint, I swear, we have worked so hard. We've worked together with people that are techie. I'm still not techie. I'm still trying to figure out how to forward my calls to another phone. But it's collaborating, right, with people that really have the intelligence and that as a know-how. So since then, we actually launched it yesterday, our small dollar lending, where you can scale it. We all know that in this country, 290 million plus have cell phones. You cannot live without the cell phone, right? If you leave your cell phone, I have to go back. My cell phone is gone. And if you lose your cell phone, it's like the end of the world. So how can we really be more inclusive in finance, right? And it's about time, for crying out loud. This is the number one country in the world. It's unacceptable to me that there's still 46 million that have access to banking. What's up with that? So I think it's really about time that everyone should be part of it. Not everybody's bankable. I understand that not everybody will have access to loans, but I think if we design something that it's so easy to use, right? And the highest form of security, the in language that they can apply for a loan, that they know that if they deposit their money, the money will, even though, FDIC will secure the money, right? Because still people, my pastor Jack is saying all the time, they still want to put the money underneath the mattress. So and a lot of people, the last panelist, right? Some people are still issuing a check by paying. but this technology that we're doing now, and not just the NAAC, right, but others, the Amazon, the Milken Institute, I mean, everybody else. And because of what you guys have started, we're seeing more collaboration. Like, what system do you have that I do not have, that what we can work together? Because the bottom line is having access to the banking institutions. There's a lot of banks do not have the brick and mortar, and I don't blame them. It's just too expensive, or just because of the labor shortage also, right? The line usually, and the social distancing, I mean, the line is like Jericho, line outside looking for the bank. So what is if they can just go on their iPhone and apply for a loan, give them some technical assistance? Not everybody will be there, and this is why, to me, the CDFI, the nonprofit organizations can work together to provide that technical assistance. A lot of people just get denial, right? And they don't know why. And they usually do not give an explanation. They just get a letter. There's, oh, because of your credit scoring. Well, what does that really mean? I mean, what's my credit score? And then your credit score, of course, it depends on the end of the day, right? Or depends the end of the month, or if your credit score goes up and down. So I really believe that scaling it, and also, people, foundations, corporations also investing on this technology, forming a collaborative together, so everybody, for once and for all, is bankable.
Wow.
Amen.
Faith, I feel the passion coming from you. It's just amazing, just watching it. Anybody want to add some thoughts on that? I mean, I could feel the emotion that comes with it, especially the part about people having money in their mattress. Believe it or not, I bumped into someone in the summer who's actually doing that, following their grandparents' way of doing it. It's just amazing today. So, any follow on to that? Any thoughts?
Yeah, this is Thomas.
Absolutely.
So, it's funny. We just crunched some data, and this will probably surprise no one, but folks with disabilities remain sort of the most unbanked general population that there is. So in 2017, the number was about 18%. But I'm happy to report that we just crunched some FDIC data, and that number has gone down to about 16.1% over the last couple of years. And we're really excited about that. But it's exactly what Faith was talking about, right? It's partnerships, it's work that the FDIC has led, it's banked on, it's all the organizations Faith has mentioned. But man, technology is just such a huge piece of that, right? So again, blind guide, right? So this phone has access to all my bank accounts and investment accounts. I can send my college kids money with the click of a button. Anyone else have kids in college? You know what I mean? And it is completely and utterly accessible to me. And that ease of use, that accessibility, that outreach to more and more people, we're seeing those numbers even within the disability community change. I will say, though, that the other thing that we've seen is that at the intersection of race and disability, the numbers look even less good. So there's still a lot of work to be done in this area, but things are improving, and technology is a key aspect of how and why it's improving.
Yeah, I would also add it's easier for your kids to spend our money too, right? Just to let you know, I know my daughter does it. She's probably doing it right now upstairs. So, but very, very insightful on things of how this technology, and we mentioned a couple of things. A lot of pros, right? A lot of pros, and there's a lot of cons involved in here. And I'm going to do a quick time check, because I really, really would love to get to that question that I have. I'm looking. Absolutely, we got time, so I'm excited. So, we talked about technology. We've been discussing the effects of technology on DEI. The previous panel really discussed some had some conversation on artificial intelligence, and I mentioned it earlier. As a technologist myself, I do understand for a long time that technologists, computers were designed to conduct repeatable tasks for humans, including mimicking human logic for decision making. So artificial intelligence, machine learning are emblematic of this desire for programming, coding, logic algorithms, programming a computer to assist with these types of repetitive and time-consuming tasks. However, there's a risk, and we barely touched on it as we talked about some of the other topics here, and it's called machine learning bias, also referred to sometimes as algorithm bias or simply machine bias, where results and outcomes that come out systematically prejudiced due to erroneous assumptions, thresholds, because in the back end, really, it's all math that may sway one way or another, potential bias. While the financial industry continues to use AI and ML technologies and the advancements of AI and ML technologies, with that understanding of those risks, as we talked about the communities that we're servicing and we're discussing, the unbanked, minorities, underprivileged areas, what are your thoughts here as it applies to DEI? One of the first things I think about is applying for a mortgage, as we discussed earlier about the fax machine example, where you apply, you try to get the information, it looks at everything, but from a machine's perspective, it's just going to look at certain codes, and for some reason, somebody make a decision whether someone's going to get a loan or not get a loan. And in some cases, that may be swayed one way or the other. What are your thoughts on that in the DEI perspective? Oh, Faith, absolutely. I'm going to hear some passion here.
No, it's because
I
I really find machine learning, I find it biased. There's too much data segregation. I don't want to hear this segregation anymore. There should not be, like banking institutions, they have their own data, credit scoring, they have their own data, mortgage company have their own data. Even in the doctor's offices, right? You go from one doctor, you go to, you get hospitalized in a different state. The data is different. And then, so I wish the data, so to me, my understanding is the more information you put in there, the more data, the more this machine learning is intelligent, right? That's my understanding. But if you don't put all the data, so for example, myself, it took me a long time for my credit scoring to go up because I short sale my home during financial crisis. And prior to that, I put 20% on my home. And at no fault of my own, I was very honest that I cannot afford this home anymore. I short sale it. It took me 5 years to increase my credit score. What happened to my character, right? So to me, if you're going to do this machine learning data, be more compassionate on what the person is, right? But I don't know if that's really showing that. What I'm seeing from the people that we counsel, right? Their credit score is low, or they have no credit score at all. But their character is good. They have the ability to repay. They have a job. One client of ours is a nurse, but because she has 3 students talking about sending your kids to school, and all that the like the tuition that they are they're collateralized of that, so her credit score has gone down, so she always has to go to a payday lender, but she has the ability to repay. So I find it biased, and I'm still hoping that with what you're doing now on this technology, that there's not going to be a lot of data segregation, and also the character, the behavior of the person can be taken into consideration, and also a one-on-one coaching after that. So if the computer says you're denied, I really think they should be given another chance talking to human being why. Thank you.
Very, very heavy. Anyone else? Kat, go ahead.
Yeah, I'm happy to chime in really briefly. I'd say just 2 things. One mantra we have at C-Note is who's not at the table. So in our humble opinion, when you design technology, and if you are intentionally trying to create greater diversity and financial inclusion across this country, you have got to have diversity at the table when you're designing these systems. And if you look back at most of our technology, they were actually not designed by what most of us look like on this panel. So I would start with who's not at the table when we think about designing systems, even thinking about what those data inputs are and what even those questions are like. So garbage in, garbage out. So I'd say who's not at the table and really making sure there's diversity at the product design, product management, and delivery table. And then secondly, I just say you get what you measure. There's so much that I believe, Faith, Nikita, and Thomas said that resonated so deeply with me around access. How are we really spot checking access? Are our systems truly accessible? And you can't assume they are. So even when we build these complex systems, how do we make sure they're actually accessible? And I think you get what you measure. Are we using diversity as a lens of measurement of success in terms of data outputs and impact? And so those would be my two thoughts of how we not get into the same type of inequitable boat that we find ourselves in today.
You hit the nail on the head when you talked about the design and who designed it. If I remember, or if I recall my technology history, AI was really started back in the 50s by a number of small group of individuals. Now you look back at the 50s and think about the economic environment and the environment in general. Just imagine that, right? Computers just do, as I've told people before, in supporting technology, when they do something and I say, well, why did the computer did that? I would say, well, a computer only does what you tell it to do. So the more data that's out there and the more it starts learning, you're still telling, even though it's called machine learning, you're still telling it at one point to say, because of this threshold or what have you, do X, Y, and Z. So that's a very fascinating point that you mentioned. A very, very good point in this. Anybody else would like to talk about this? I know we can have a panel by itself just talking about these risks that potentially can be biased in one way or the other. Now, again, let's be very frank here. A lot of pros and a lot of benefits come from the digital transformation and just evolving of technology. So, but there's always risk. There's pros and cons to every story. So, does anybody else would like to add more to this? Because I'm so glad we got a chance to ask this question and have this time here with the panel.
So Isaac, I would like to add a little bit because I think Faith and Kat both made extremely great points. Just thinking about the way you describe machine learning is it's like human logic and decision making. Well, by definition, we're humans and we have flaws. And so if our machine is mimicking our thoughts, right, there are challenges with that, whether it's biases or any other flaws. And so when I think about the point that Kat made really is garbage in, garbage out, right? If we don't have an expansive, diverse group around the table, then we're going to get that same outcome. And so when I think about this, I think about using machine learning as a part of a decision point. It's learning. It hasn't graduated yet. It's still learning. And so to get to that graduation, I think we still need that human, some aspect to Faith's point. Banking, finances, it's a relational business. And so there's a space for adding that relation into that. So that's what I would add, because there are pros and cons, but I'm a believer in trying to work at something and help it to graduate.
Yeah, how do you bring human emotions into this? It's very difficult to do that. I mean, humans themselves are incredible organism and how it works. So how do you do that? As a former old programmer myself, I keep thinking, how do I do that? How do the coders of today, the young ones today, actually add that? I've had an issue like Faith's example. Things happen and you go on and you do everything you need to do to try to get. I remember one time that if your credit was bad, you get a credit card and use it a little bit, pay it off every time, and you hopefully that your credit score would go up. But why did it take long for Faith? It's fascinating conversations and definitely conversations with that. Thomas, you have anything that you want to add on that? We haven't heard from you on this.
I thought Kat made a really great point, and there's an old saying in the disability community that goes, "Nothing about us without us," right? So I think if you have everyone at the table, working on the project, you'll get that compassion, you'll get that human intuition that's more representative of more people, and you end up with a better product. If we're building a product for everybody, we need to have everybody at the table.
Absolutely. This is fascinating conversation. I reminisce to something else that I used to say to people as far as resumes concerned. I'm not going to keep this company out of this conversation here, but at one point, this particular company was using an AI to filter resumes. And I'm looking at the panel right here, and out of 1, 2, 3, 4, 5 of us, 3 of you wouldn't even get an interview because it found that and this is what really struck my need to ask this question. But 3 of you, the women, would have been pushed aside because it was found to be biased. Now that company has shut that down and doesn't use it anymore. But just imagine, I used to imagine giving my resume into a job that I particularly felt that I was very, very qualified for. And I would always imagine someone at a desk looking with a stack of paper resumes, look at mine and sees the name Hernandez and pushes it aside because of the thought and the bias that I might not be able to be articulate in English as somebody or what have you. So now you have machines actually mimicking that. And, all the points that we made here is awesome. So looking at the time, I want to give the opportunity for all my panelists to give final thoughts, final takeaways as we end this particular panel. And I'm going to start again with the same. Yep, because I see you, Catherine, Faith, Thomas, and Nikita. So let's start with Catherine. Any final thoughts, any takeaways that you would like the audience to leave with?
2 quick thoughts. Number 1, I am so excited about everything the FDIC is doing, the innovation, the commitment to diversity and financial inclusion. So I just want to do a shout out. Wow. In my lifetime, this is tremendous. And also to Betty Rudolph and the new Office of Minority and Community Banking. We could not be more exciting to get to be on this journey of really using the power of banking as a tool for financial inclusion. And then I would just say, it's going to take a village. I think if we're really serious about creating greater economic opportunity, regardless of how you're born, to whom you were born, the color of your skin, it's going to take all of us. And so I'm a big tent person. Reach out. We'd love to hear from you at C-Note. And we're all about partnerships because, again, I do think for all of us to achieve this, it'll take a village.
A village. That's fantastic. Thank you, Kat. Faith, final thoughts.
Diversity, equity, and inclusion, take this seriously. From the board of directors, if you cannot have a diverse board of directors, create an advisory board that will have a diverse thoughts. We should all be at the table. Your ROI comes from a lot of us. We should have a say. I cannot emphasize enough that we are your customers. We are your people. Create some programs, create some products that includes all of us. Inclusivity, not exclusivity. Please take that in your index card. Every morning you wake up and every time you go back to sleep, that we are all in this together. We're all equal.
Wow. Affirmation. Thank you, Faith. Thomas, my man, how are you? Any final thoughts you have for the audience?
It's a hard act to follow.
I know.
I guess I'd focus on a couple of things. Absolutely. Start with diversity, and remember that disability is a big part of diversity. There's 54 million folks in the United States with a disability. And also be really intentional around it. And this is why, because I've been doing this work for a while, and the story is that inclusion works. I've seen people with disabilities on SSI get their first job, and that leads to a second job, and that leads to a full-time job, and that leads to a job not only with benefits, but with stock options. And I've seen people with disabilities put their kids through college, buy homes, build careers, largely because of technology, but always because someone was intentional around inclusion. So if we want to build a better financial future for everybody, let's start with diversity, let's do it intentionally, and let's do it right.
Wow. I don't even know how I can follow you guys. Just you're doing the final thoughts. So, who runs the world? Nikita, what's your final thoughts?
I love the Beyonce reference. Yes. Okay, so because it's hard to follow Kat, Faith, and Thomas on this, but what I would say is that continue the conversations. To me, the most complex machine we have is the machine of being a human. We are complex machines, and so we have to continue the conversation, continue to learn this machine of who we are, and that's the path to helping us create a more inclusive financial system for everyone. So that's what I would say.
That's
Run the word.
fantastic. That is fantastic. Fantastic. Look, on behalf of the FDI Tech and the FDIC, I'd like to thank all of the panelists for their time and their insights. I am truly, truly honored and privileged to be part of this dynamic discussion. I personally like to thank the FDI Tech team and the FDIC as a whole for setting up this awesome event today. So with that, I want to say to everyone, DEI, hold it to your heart is extremely important. I want to mimic Kat for saying what she said earlier, that it's in our lifetime that we're really paying attention to this. And I hope to continue to grow old and see that. So thank you, FDI Tech. Thank you, FDIC, for setting up the awesome event again. And with that, keep innovating. And I'm going to pass the baton back to Jeff DeLuca to bring us home. Jeff, you have the mic. And thank you all.
Thank you, Isaac. Wow. A lot of great discussions today with brilliant panelists. Banking and fintech, we covered a gamut of topics from payment systems getting sexy, the metaverse, Ready Player One came up, to artificial intelligence, machine learning, stablecoins, tokens, to quantum computing and qubits, to innovation in diversity, equity, and inclusion, and the move to a remote workforce, areas of technology that can be leveraged for DEI, but also risks of new technology and bias. Like many others, I'm sure I'd be happy to talk about this all day. But before we close out the event, I want to say thank you to some people that without this event would not be made possible. First, Sultan and our remarkable panelists and moderators. Also, a partner in organizing a lot of this event, Ramsey Benora, and the person who brought it all together in a great virtual arena, Shannon Greco. We also have those that did an amazing job with our graphics and communication, Brian Sullivan, Mary Horing, April Brown, Hyder Inman, Ed Warwick, Carly Brewster. I also want to give a thanks to our legal team, especially Chris Ledoux. And finally, I want to thank my fellow FDI Tech members for coming together to put this event together and get it done. So thank you, and tune in for the next FDI Tech event. Thank you.